Good morning, everybody. Welcome to Trade Live with IG for Thursday. I forgot what day it was there. Thursday, the 23rd of October. It is me, Chris Beecham, in the chair this morning, joined by the inimitable, the irreplaceable Aaron Bright.
Hello, Chris.
Good morning.
How are you?
Thank you for having. I'm very well. Thank you for coming in.
Oh, it's a pleasure.
Still early in the morning as well. I know it's a bit early for you.
No, it's all right. I'm actually an early riser. I am.
You fund managers don't usually start this time. You sort of drift in about 10 o'clock.
Oh, yeah. Yeah. We know that you like to get in at, what, 4:30?
It's the moral advantage you see when you come in and there's nobody else in the office. So, yes. What a lovely day. Good morning to everybody in the chat. Good morning, London Guide. Good morning, TARDIS. Morning, Jugger. Parky, 1977. Maturin. They're all here. The gang is all here this morning. And what is a beautiful day in London. It was tipping it down when I left the house this morning. It was wonderful.
I left my house today and I could just hear the trees howling.
Yes, it's always great, isn't it, where you can hear the rain before you leave the house.
Yes, and I was hoping that wouldn't be a foreshadowing event of the day to come, hopefully.
When do the clocks change? Next week?
This week, I think.
This weekend? Oh, no. Okay, fine.
It's going to be in perpetual darkness now.
But yes, exactly. I always get to work and leave work in the dark and leave in the dark for most of the year, so it's fine for me. I don't mind. Excellent. So, shall we see what's coming up this morning? What have we got? Aaron, do you want to take us through?
Yeah, absolutely. We've got overnight action with myself and Chris Beecham right now, and then we've got the opening bell at 8 o'clock. 8:10, guess the chart. 8:15, myself and Martin Harris are going to be tuning into Man versus Machine. We're up against AI, trying to beat them at managing a portfolio. 8:30, Expert Edge with Rich McDonald and Julian Wheeler. And 9, Expert Edge with Rich McDonald and Sammy Ellard King, which are, of course, rebroadcasts.
Like the BBC, we're going to run repeats. Good. Fantastic. Any clues on how well you've been doing this week in the portfolios?
Well, let's just say that some of our bets are beginning to pay off, but I'm not going to reveal too much. You're going to have to tune into the segment to find out. Of course. But I'm pleasantly surprised when I was running through the data. So.
And you're still battling, Martin, to get that cash allocation down? No?
Well, it's a complicated one because it's markets are high, and we saw even in a volatility event last week where the S&P was down about 2.8 in a day, and
there was your gap, there was your dip. You should have bought it.
Exactly, and it's recovered, but it's just if there is a sudden change in sentiment, and then we deploy our cash too early, it feels like we're performance chasing a little bit.
That's why you earn the big bucks, isn't it, for being the fund manager? Good. Should we go to overnight action?
Let's do it.
Let's talk about what we've had overnight. Big moves overnight being oil prices. Do you see this one?
Yes. It's all due to the Russian sanctions, I believe.
Yeah, the man himself has decided to fall out with, let's see it on the chart, I think probably is, if he decides to fall out with his friends in Moscow, or he likes to call them friends in Moscow. I'm not sure they're very friendly with him, but anyway. So oil prices surging off those lows we saw earlier in the week, because he's not going to Hungary now, not that he really was in the first place.
No, and there was all rumours about what would happen if he flew over Polish airspace and whatnot.
Yeah, the Lovin has been cancelled this time around again, so it looks like he's trying to put pressure on them in a very different way. So that's why you've got oil prices on the up this morning. So we've got Brent currently trading at 64.45, US crude back above $60 a barrel. But of course, if you look at that, it's been a sell the rally trade all the way through.
Definitely, yeah.
You wonder how much that changes.
It reminds me of a few years ago when we were, $100 a barrel.
Remember, let's not talk about that one. Every motorist remembers that one. And then, of course, you had a bit more weakness in Hong Kong and China stocks overnight because he's talking about, what is it now, curbs on, the headline. Oh, you see I'm prepared for this, can't you? There was a China story about more sanctions on China or trade limitations.
Yeah, I mean, in general with China, there's just an enormous amount of volatility at the moment. As you can see from that chart towards the right-hand side of it, as we get close to today's date, and it's really just as a result of the changing rhetoric around trade and tariffs, and we just know how volatile the index can be, really.
Yeah. With
regards to how Trump changes his mind.
Very much so. So yeah, China overtaking US as Germany's top trading partner. And also, I think there was a comment that they were going to consider curbs on exports to China made with US software. So it just continues to rumble in the background, really. Yeah. But they're still expected to meet, aren't they, in South Korea next week?
Sounds a bit like a cold war brewing.
Yeah. Well, it's brewing even more so, yeah. So your security dilemma coming through. So that was a bit of pressure. And then also the Nikkei off a bit. Really just the hangover still coming through from the election of the new PM.
Totally. And we were just discussing earlier that, if you'd bought a Nikkei tracker in sort of around the 10th of April, you'd be up over 50%. So there's definitely elements of profit.
You may have been deterred for one reason or another from buying at that point. But yes, 50k. I was wondering which, I think the Nikkei is still edging it, isn't it? But Nikkei or Dow to 50k first. Sorry, my Dow chart not working, which is always great. But yeah, this is the key one. Which one crosses the nice big round number first? And then what happens?
I think it could be the Dow, maybe.
Probably. Yeah. That's definitely a poll. Definitely could be a poll for that one.
Which one
gets to that?
It could go quite close. But the Japanese index has some interesting volatility events if there's a change in sentiment there.
Yeah.
And we saw, about 18 months ago, the infamous carry trade debacle really throw the index into a bit of chaos.
Because you've had to have the patience of a saint or a Japanese Zen master, if you like, to hold the Nikkei through.
It was called the Widowmaker's trade.
Well, exactly, to hold it through 3 visits, really, in the space of about a year to 30,000 or so, and then right back up again. So it has paid off in the end, but it has not been easy. No. You haven't had the smooth ride you've had in US stocks, have you?
Beloved US.
In beloved US, I know. But there we go. Fantastic. Good. What else have we got moving this morning? Should we look at the newspapers? Should we do the headlines?
Let's do that.
Let's get my headlines up. Let's do the FT first. Here we go. Front page, the FT. So there we are. US imposes sanctions on Russia's Rosneft and Lukoil.
That's definitely why we're getting the reaction in oil that we sort of are beginning to see sort of soak into markets, I guess you could say.
Yes, a terrible, terrible pun. Yeah, so that's going to be an interesting. So if there's further to go on that one, whether there's any, and whether he does change his mind again on those Tomahawk missiles.
Absolutely. Yeah, that's a big one, and I guess will determine, the bullish and bearishness towards peace.
Very much so. But then a lot going on, of course. We've had Tesla.
Yes.
Tesla profits last night. So
down 4%.
The stock price didn't do well. And again, after Netflix, which also... Netflix, you have to be fair to, they missed it because of that Brazil tax charge.
Do you think there's just so much expectation baked into tech stock earnings now that even if you get a strong earnings that's just like not quite in line with guidance, you're just going to get investors throwing tantrums?
There is a certain element to that, but you would say you've got a profit that's dropped more than a quarter.
Yeah.
Even though you had record car sales. And yet the shares, they were down, 10%?
And with Tesla, it is a quite unique stock that it's almost a political stock in a way.
Well, yeah, this was highlighted in the FT article saying, of course, that adjusted net income was down 29%, but also I think the concerns that what Musk has been doing over the past year has obviously detracted from the stock.
Definitely.
And also this looming argument between the shareholder base and Musk over whether he gets his massive pay package.
Yes.
That's certainly been the key thing to bear in mind.
Absolutely.
And the rising EV costs from those rare earths.
Well, yeah, it's an enormous cost to import these rare earth materials and to convert them into batteries with, I think, lithium being probably one of the major ones being used. And we know that China has got vast swathes of lithium, and I guess, from the US perspective, they're going to want to keep China sweet in order to get that lithium to achieve their net zero targets. But I guess with Trump in power, we know that drill baby drill is back. So
it is.
How much push is there going to be towards clean energy? That is the question.
Precisely. So there's your, look at that. That's your chart for Tesla. It's going to, I think we need to clean that chart up from what that price movement. But so let's do it on a weekly, shall we? There we go. Oh, I definitely need to get somebody on that chart. But so the record, not quite record highs, just about a week or so ago, 2 weeks or so.
I mean, that looks like something you'd see at Thorpe Park. That chart. I mean, it's a real roller coaster.
It's been definitely the ups and downs, but it's held up relatively well.
Yeah.
Just moving sideways. So I think the interesting thing, perhaps, you're right that they are dealing with high expectations at this point.
Definitely.
But maybe the fact that they haven't reacted even more poorly to those results is maybe the interesting thing. You had Netflix down another sort of 5% yesterday, down to 10% overall.
Yeah, I think the investors know that the earnings have been still within range of a pleasant earnings season so far, but not too.
It's not quite the sort of exuberant season they were hoping
And I think
for.
elements of that is that we were, I think for about 3 years, every earnings season was like, okay, is this going to be the one where we have rates be detrimental to earnings because they're going to squeeze the consumer so much? And we haven't. So the guidance and outlook has always been, I guess, slightly lower. And then earnings have come in, smashed all expectations. And now they're not quite smashing them as much. They're doing okay, but I think, that's why investors are not as worried as one would expect, but they're still, a little bit concerned.
Definitely. The other news this morning, Lloyd's, of course, reporting everyone's favourite stock on IG.
Absolutely, yeah.
So another, if you get on the screen, get the screen up, Lloyd's, another dire number from them. Of course, we knew about the car finance impact.
Yes, definitely.
But 800 million charge to the car finance. Bank and mis-selling, and again in a sentence is like seeing 2008 all over again, really.
Yeah. If you had £1 for every time you wrote an article about that.
Exactly.
But I think the FTSE in general has had a decent.
Well, yeah, we should come to
days.
that one yesterday. Let's just finish off with Lloyd's first. We kind of all in the news with this. The group performing well, strong capital generation. And again, let's have a look and see where we are with the share price in Lloyd's. There we are. As one of the solid, well, it's quite good dividend payer, of course, as well, isn't it, really?
Yeah, it is a chunky one.
I wonder what the indications are we've got for Lloyd's. I don't know. I have to wait to see what we get for that in terms of opening up or down this morning. But there is your steady rally. There is your steady bounce in the share
Not quite as volatile as Tesla.
Not quite as volatile as Tesla, for which I'm sure Lloyd's shareholders, that's why they're in Lloyd's rather than in Tesla. But a high street bank to double in the space of, it's nearly 2 years now, of course. But they finally come back into their own.
I mean, yeah. And I think an element of that is, I mean, they were just so brutally attacked during COVID, metaphorically speaking. The stock prices and sort of UK equities in general were just at such lows during that period. I think there's definitely elements of a sort of, a bit of a bounce back from that. And there's been, speaking to other fund managers, I think the rhetoric for a while has been UK equities in general have been so unbelievably cheap that eventually they just need that little oomph. And then, once they get that little oomph, whether it's through government policy, interest rates, whatever, that there will be a rally because the actual underlying fundamentals are quite positive for these equities.
Well, because this we were talking about before the show with the news from yesterday and the UK CPI figures.
Yeah.
What was your take on that?
Well, I mean, it came in cooler than expected, but we're not getting like a 1% inflation print. It's still, nearly 4%. So it's better than one would expect, but it's still nothing to write home about. And obviously, as we were discussing earlier, we saw the FTSE really go on a bit of a blistering run yesterday. I mean, nothing too crazy, but I think it was around 1% upwards or 0.9%.
Yeah, I think it
upwards.
was.
And we're seeing the likes of house builders rally, and people are getting over exuberant, in my opinion, about the prospect of a potential rate cut before year end or very early next year, just because an inflation print is slightly better than expected, but it's still not a good inflation print.
No,
it's I wouldn't be happy if I was Andrew Bailey and I was delivering 3.8% inflation every year, because
obviously more than nearly double the target.
Absolutely, that's the issue.
I suppose again it's
so starved of some degree of moderate inflation.
Markets forward looking, etc., etc. That the hope is that, and it was the second month in a row that that core CPI declined, which is not a sentence you've been able to utter about UK inflation for a while because it's so much higher than the continent. But as you can see, there's your FTSE 100. We are knocking on the door of those record highs once again. So I like to knock the FTSE, I have to say, because it's full of companies that, compared to obviously the glamour you get with the US and the cash generation, the profitability you get with the US, it pales in comparison. But it has had a very good run.
It has, yeah.
It's been a strong beneficiary of the kind of escaping the US area.
Yeah, and if you saw this chart and it didn't have a label on it, I think people would say, oh, that looks like a US equity, or that looks like a US index if it didn't have FTSE 100 plastered across it, because the returns have been impressive, and is obviously a very core holding that we have in our portfolios, and it's been pleasant looking at the returns of it every month.
And you are getting what, 4% yield? I think on the index
definitely.
itself, and then but it was a day for the mid caps as well. Actually, we don't talk about the 250 perhaps as much as we should.
Well, that's definitely a rate trade, I would say. I think it's a rate and domestic focused trade. So whenever there's prospect of rate cuts, a lot of these companies are going to be quite growth sensitive. You know, when one talks about rate cuts, people favor growth stocks because it essentially increases the model value of a business through higher discounted present cash flows if you have a lower discount rate with interest rates coming down. And people think about that immediately. If an inflation print comes down, they automatically think, well, that means the interest rate's going to come down. That means these companies are, you know, have more prospective value. So yeah, it's definitely an interesting one. But I think the concern with the FTSE mid cap and the FTSE 250 is whether you know, if the domestic policy isn't as good from the government and, you know, the consumer's stretched, how well can these companies do?
Exactly. I think this is the key point. But maybe there's just too much bearishness about the UK economy. Maybe this was what we saw yesterday, that finally, after months and months and months of it, it's begun to look a bit cheerier. Yeah. And again, they're not record highs for the FTSE 250, but we are back at those highs from July, which is nice to see, really.
It is. So yeah, I think if the UK gets its act together, inflation and economy-wise, there are some fantastic companies there.
Very much so. What else have we got? What have we got this morning? What else has been moving? Unilever. We should talk about Unilever. See if we can find the news this morning in them. My website decides to work. No, there we go. Well, let's do the Times. Let's see if we can get the Times. No, very slow moving. I don't. My network's not working this morning. Uh-oh. I was going to talk about Unilever. Rotating screen of death. I think. Should we go for a quick break? Should we see if we can get my internet working again?
Yeah.
The hamster. Yeah, we'll see you in about a couple of minutes.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Welcome back to Opening Bell. We have chased the gremlins out of the network system, we hope, for now. Aaron.
Yes.
Talk about India.
Yes,
Talk
we've
about
got
India in
an
the chat.
interesting comment from Maturin about India and Korea ETFs climbing steadily. And I think this is just a reflection of the broad positive sentiment we've seen in emerging markets. As the sort of trade debacle, tariff debacle's cooled, emerging markets tend to just be a beneficiary from it in general. And I think they're the best performing index this year, just the emerging market bundle, because I was looking at some figures for a webinar we did on the smart portfolios, and the emerging market returns have been fantastic after having a period of some really poor returns post-COVID, the past couple of years. The returns have been excellent. I think one thing to watch out for with India is that relative to other emerging market regions, it does trade a bit of a premium. So that's something to watch.
Why is that? Why does it get that?
I think it's seen as a quite sophisticated market in emerging market, I would say, potentially. You've got some really strong pharmaceutical businesses, industrials in there, and I think it's seen as potentially one of the more safer ones. You've got an amazing tech sector. Obviously, there is disparity in India, but if you're looking at some of the regional hubs there, Mumbai and Delhi, you've got some fantastic tech, and Bangalore, of course, some fantastic technology and healthcare sort of hubs there.
A very solid performance in the ETF.
Yeah, really strong.
Just correlates essentially with everything else, stock market wise. But since early 2023, it really has found its footing, hasn't it?
Yeah, absolutely.
You've got this issue, obviously, Trump has fallen out with Modi, and the closeness with Russia brings in that geopolitical element.
They've been benefiting as well from, I believe, some Russian trade. So that's another reason why I think they've been able to sustain, fairly good, strong performance.
I know. Talk about there's obviously an ETF do that, do you?
No.
There's the South Korea capped ETF from MSCI, iShares MSCI.
Once again, I think seen as a beneficiary of relative peace with regards to trade. I think that's a big reason why we see South Korean stocks do well.
Talk about that breakout, really. Just been absolute storming performance.
Yeah.
Good. Yeah. What else we got in the chat? BME. Oh, we're going to do Antofagasta as well. Should we do Antofagasta first before we do BME, which is this week's disaster story? But Antofagasta, now there is the copper miner you wish you had bought. Look at that. Look at that absolute run from a weekly. But even on the dailies, more than doubled. Again, the number of things that have doubled in the past 6 months, or admittedly from those lows, but just seeing an absolute storming run is quite impressive. But the obvious beneficiary of those copper prices, a little bit toppy in the short term. You can sort of feel the volatility coming back through here at the moment. But an absolute.
Do you think that's related to the gold issues and just commodity?
Yeah,
in general?
as Andrew McKelvey saying, Antofagasta have reduced their unit costs and increased production of copper and gold. So just delivering on all fronts in many ways. And if you can keep those production costs down, you've got the price going up. You've got very much the virtuous circle to deliver for these miners, which is great news, of course, for the FTSE 100 as well. So Antofagasta, I'm still an Anglo-American. I just leave it to run and run. But
you had an unfortunate week on I think it was Tuesday, an unfortunate day.
Do you know, I stopped. I didn't even look at it. What have we got from Anglos? Didn't they pull out of a joint venture? I think it was.
Yeah.
There was something in a week. They clobbered the other company, and it was Tiny Mining Company got clobbered by over 50%, wasn't it? I think it was. I'm sure the chat know which one I'm talking about. I can't think off the top of my head. Well, it's not too bad. It was nearly £30 a share in October. I'll take that. I was quite happy. BME. We should talk the sort of disaster story of the week. Poor European value. Has it found a low? The answer, our survey said no. We need that sound gallery, please. Can we have that? Get that one sorted, because this is what you had: finance director leaving, cost increases, profit warning, all in one RNS.
Like a wonderful company.
It was a really wonderful start to the week for B&M, and it was.
They're going to have a special situation fund managers looking at that stock inside out. Probably.
Oh, it'd been out dirt cheap on so many metrics, but it has, as you can see from the chart, it's one of those things where cheap things
you catch a falling knife.
Tend to get cheaper. Yes, exactly. And you just think it's turned a corner, and then oh no, it hasn't. So you've had 2 days of tiny bounce. Not one for me, I have to say.
Brian Tuck has said in the chat, Australia has lithium. So that's an interesting one, because we were talking about the rare earths. So, but I don't know if you saw yesterday, or I think it might have been 2 days ago, Trump having a fallout with the ambassador to Australia.
No.
Ambassador to the US.
Really? What happened now?
Oh, it was just they were commenting, and the ambassador was there, and they referred to. I think he said, "Oh, the ambassador's made some bad comments about you in the past." And Trump has said, "Oh, is he still in the post?" And he was sat there.
Oh no!
And then Trump just said, "Oh, I don't like you. I don't like you," or something.
I've got to watch this.
It was quite funny. Yeah.
Oh, okay.
It was just vintage Trump.
Vintage Trump.
Yeah.
Classic moment. But
so hopefully that won't affect it too badly.
Oh dear. But yes, rare earths. Another. If Australia can boost this is your key one, isn't it? Really, if it can really keep moving. And the US-China fallout continues. And there was an argument saying, obviously, sorry, I put the chart up and then I'm not talking about it, but yeah, look at that chart, absolute storming run from the rare earth. Again, sort of, it's doubled from the lows in the past 6 months. So there we go. Yeah, chart off. There's an argument that says, though, of course, China moved too soon with this rare earth.
Yeah.
That they haven't yet quite achieved the sort of stranglehold on it that they wanted to. And obviously, you've got Besant talking about doing an Operation Warp Speed on rare earth production. Mm-hmm. So that could be Australia beneficiary for that one, really.
Definitely, yeah. Be interesting to see.
Good. What else have we got? Automakers looking at problems with the Dutch, Chinese. Yeah, because the Dutch have taken over this chip firm. And that has obviously gone down badly in Beijing. But is it a sign of more to come? Is it the sign of others likely to take control?
Well, I think people do want to onshore their production of these sort of vital tech goods. They don't want to be at the behest of a potentially belligerent or nation. So I think that's something, we saw Taiwan make extensive use of pretty much since its history as being a sovereign state in its own regard. And that's why it built what it's called, its Silicon Shield, where it essentially has built such a strong tech and chip industry so that they are almost uninvadable, because if someone were to invade Taiwan, you're basically limiting the supply of around 65% of the world's semiconductors.
Yeah, and that would be
a very clever way of doing it.
The economic ramifications is quite something.
Yeah, I wonder how many semiconductors are currently in this room.
There we go. So we are on the cusp of the opening bell. 2 or 3 minutes to go. Let's see if we can
edging lower or edging higher.
Wow. Let's see. We're expecting. I think we're expecting. What's the open from the FTSE 100? Opening at, well, not at record highs, but obviously another good day. A stormy trade of the week. And how's my trade of the week on the DAX doing? There we go. We were long DAX from Monday. Had an absolutely storming day on Monday. Just a little bit of indecision creeping back in again here, but holding up nicely. So I'm still. I think my entry was about 24. Where were we Monday? Hang on. 24, I think roughly about 24.80, I think it was. We got it before it went absolutely storming. We might be about roughly flattening it so far, but the key thing is not been stopped out. So I'm happy with that one so far.
Always
Long the
how you're doing okay.
Yeah, so holding on quite nicely. Good. What else have we got moving this morning? What else is on the move?
Well, before we get to the opening bell, do you think this gold move is going to last?
We should do gold. That's a good one. Poor gold. Gold! Did you do it deliberately? Clearly.
It's a great song, that.
Well, as a fund manager who's seen something go like it has, how do you take it? What's your view on it?
Well, gold is an interesting thing because you can't actually really value it using traditional models, and it's used as a diversifier. So many fund managers, apart from a few that I know, will have gold in their portfolio more than maybe 5 to 6, maybe 10% at most. So it's been a really fantastic diversifier. The performance has been fantastic, but it's not got the growth aspects that the equities do. So it's in there to serve a specific purpose, which is done with, exceptionally well. But I think people knew that there was potential headwinds at that price. But I think if you're looking at where gold is likely to go in the future, I think there is some tailwinds with regards to geopolitical conflict, central bank buying, and also sticky inflation.
I think this is the key thing, isn't it? And just looking at silver, we have an absolute storm in that one.
Yeah.
And then it's come off again. And then
in August, I think the ratio the gold to silver price was something like 1 to 88, which is like the highest it's ever been
Right.
since ancient Egypt. So, when they were comparing the prices.
Good nerdiness. So 15 seconds. Have you got your bell, Aaron? Are you going to ring the bell this morning?
Yes. LSE bell especially.
Oh, he's poised. Look at that. You just need a bigger bell. So there goes your FTSE on the open. Let's go to the hourly, see what we got in the immediate movement there. 95.50, just nudging that in the early part of the session. What have we got moving? Let's get my FTSE 100 list up. So what have we got moving? Our winners and losers this morning. So start with, and there we are at the top of the list. Endeavour Mining, gold, right at the top of the list, 2.8% and climbing in early trading. What else have we got, Aaron, this morning?
Oh, testing my eyesight here. We've got
can
BA
read that.
Systems up 0.43%. Experian up around 0.5%. Vodafone up also around 40.4%. M&G flat for the day. So yeah, we're looking at some interesting gains. But as you mentioned, Endeavour Mining really being the
Top
big
of the list,
beneficiary.
3%. I don't.
Yeah.
Do they have news this morning? The chat might know. I didn't see them on the list of RNSs, but I might have missed it in my early rush. And then on the downside, Antofagasta. Who's gone ex-dividend? You talk. I'll
That's
find
immediately what I was thinking. That's
Thursday. Must be dividend day. What have we got?
Well, Diageo's down. I'm a very unhappy shareholder.
So today, from the 100, you just have BAE. It's tiny 0.72 impact on that. And then also today on the FTSE 250, we have moonpig.com, Morgan's, TBC Bank, quite a few investment trusts, and Weatherspoons goes ex-div. How's Weatherspoons doing in early trading? Trading update coming through, 1.4% down, so not too bad on that front. So yes, those decliners this morning, Ashtead as well. I wonder what Ashtead's up. That's interesting.
Do you think that's a bit of profit taking from the trade that we've seen earlier in the week?
Were they up earlier in the week? I hadn't followed them as much.
I think they were up slightly.
Sort of a fallen angel, really, Ashtead. Wowzers. Definitely. St James's Place. Shouldn't make fun of rivals. Down 3.5%. Numbers this morning from them. Also, Intercontinental layered numbers this morning, 1.4%. So that's a tough one on that front. Diageo continues to struggle. So there we are in.
That's been a very unhappy hold for myself.
Sorry?
That's been a very unhappy hold, Diageo, for myself.
Oh, have you got it yourself?
I do, yeah.
Oh no, these things happen. Just trying to zoom out on my thing. What else have we got? Let's see what the DAX is doing in early trading. 24,194. Okay, that's quite good. Fantastic. The trader week continues to cling on. There we go. Sometimes I get it right, sometimes I don't. Good.
I have faith, Chris.
You have faith. It's not a question of faith, it's a question of expertise, he says. Silver, I can't, now I've zoomed in, I can't zoom out again. I've suddenly made it so. What else have we got, Aaron, this morning? What else is moving?
Oh,
we managed to ruin that chart completely. Oh, let's talk about the pound. What have we got from sterling?
I mean, I think we've seen a little bit of dollar strength come back to the forefront. Be interesting to see what because a lot of that will be determined by interest rates and what our path looks like for that. So, yeah, I'm interested to see that if inflation comes in cooler in, let's say, the next print as well, will we see a weakening pound?
It's going to be the way it goes, isn't it? And it has been on that trajectory for months, hasn't it? Slowly weakening.
After a blistering run.
Yeah, because of dollar weakness.
Yeah,
Not
because of pound strength. Yeah.
No, it's well. Should we be fair? Is that unfair? Probably not.
Yeah, maybe.
You're at the mercy of other factors beyond their own control. Is it just waiting for the budget? Is that the key question here?
Oh yeah.
If everyone's just waiting to see what happens.
I think everyone I've spoken to about the budget is terrified. I think is the word.
Objective.
I think it. Look, I think.
Including Rachel Reeves.
I think that could be an interesting poll, I guess. I think, look, people are worried about how high the tax rises are going to be and where they're going to target. I think that's the concern.
Doctors and lawyers, wasn't it, in the Times a couple of days ago?
Accountants.
And accountants.
Yeah.
Well, tax them, nobody knows. Who likes accountants? Really?
I think the concern is whether they raid income tax, VAT, and national insurance. That would be a breach of their manifesto. And I think people are concerned about how that's going to go, because obviously we saw Labour, begin to raid pensions with regards to inheritance tax, making SIPs become part of estates, which had been a long-term financial planning tool, to sort of mitigate your inheritance tax liability, which had been, something which UK pensioners had cherished, being able to pass on SIPs to their beneficiaries tax-free. But that's now gone. Well, it's going to come into force in the next couple of years. But if they did that in their first budget, how much further they're willing to go, especially with such a strong majority? They're lagging in the polls. They don't have to call an election for another.
A majority, but they don't ever seem to have imposed that on the Labour Party, a fractious group of left-wingers, whatever.
Yeah. Yeah, the rise of reform, drumming up, a rivalry to Labour. And also, I guess you could say Greens and the Lib Dems are also getting...
Yes, and so the Greens and Lib Dems both polling about 15% when you've got Labour on 19. There's not much of a gap between the two of them.
Yeah, this next election, if there was an election tomorrow, it would be very interesting to see how that would go.
Interesting is the word. And then we've got the pound, or the euro against the pound, should we say euro sterling. Anything for you on which you prefer, being in the UK or being in Europe as a fund manager?
Are you talking for the equity side?
Yeah.
Look, I think there's benefits of both. I think if you look at Europe, you had a massive fiscal deal come out at the beginning of the year, trillions of euros being spent on infrastructure and defence. And if that comes to fruition, we're likely to see many companies and the economies benefit from that. As we've mentioned about the UK, I think the concern is just the government are tied, and also the central bank, even though we've seen a little bit of data say, oh, they can cut rates, or people getting excited about cutting rates. I think that with the UK, there's the policymakers have their hands tied a little bit. So I think sentiment is probably brewing more towards European positivity rather than my nationality's, my country's, sentiment and positivity towards that.
Okay, so eStocks 50, Eurostox 50 over FTSE 100.
I mean, look, we build the portfolios for very much the long term. So we've got positions
It's like nailing jelly to a wall with a fund manager. It really is. No, carry on. I'm being mean.
Look, we need to have positions in all of them. There's different qualities of all the different indices. But look, at the moment, if you put a gun to my head and said, which would you rather buy, probably based on sentiment, Eurostock.
Fantastic.
I mean, thankfully, there's no weapons in here for Chris to use.
No, it's just physical threats later on. Or stocks, what's that up this morning, Gallery? BP up 3%. When was the last time you saw BP up 3%? I'm sure somebody will tell me. Rent-a-kill, there's your win of the day, though, 13%.
Wow.
Where's my BP? Where's BP?
That's the returns of a index in a year sometimes.
Yeah.
So
well, not this year.
No.
Quite down. BP 2.8%. There we go. And Shell. So good day for FTSE 100.
Yeah.
Pretty good time for FTSE 100.
Yeah, we are. As I've just criticised
sanctions
and said why we should buy European content.
Timing is everything. Timing is absolutely everything.
But
good.
We do have these chunky positions in the FTSE in our portfolio, so we'll definitely be benefiting from this rally.
Should be good to tune into Man versus Machine. Of course, you won't get the update from this morning's trading, will you? But there we go.
From yesterday.
And then just a last look at these winners on the FTSE 100 this morning. Here, Rent-a-kill, clearly clearing out more pests over the course of the last 6 months. Up nearly 13%.
And the London Stock Exchange on the London Stock Exchange.
Well, I've got LSE, and they've talked about them losing their way in recent years, but they seem to have.
I was speaking to a fund manager a couple of days ago about why we've seen a little bit of a revival in listings, but I mean, compared to America, nothing. And they're just basically saying, if the government or policymakers got rid of the stamp duty on UK trades, UK equities, then the LSE would be a huge beneficiary of that, and we'd see more liquidity in the market and more companies want to list here and maybe higher valuations. But that's just an opinion of another in the industry.
Yeah, there were the concerns about the deals we made to buy things like Refinitiv, and it's costing them a lot of money. So they've definitely been clobbered. shares wiped out from January. But maybe there's signs of recovery in there. MACD, there's a weekly chart, some MACD crossover there. First one we've seen in months. That's a positive sign at least. So there we go. I speak as a shareholder. Long-term shareholder on that one. So we'll just have to see what happens on that one. And then what else? The last ones we've got to finish off with. So let's see, Endeavour Mining.
Let's see if there's any I hold there, which I can talk about as a shareholder.
No, she's talking about, but Rich does it all the time. It's fine.
Rolls-Royce is one I own, which has been fantastic. I mean, that's up 1.2% on the day.
There we go. So there your. Don't forget your feedback in the poll, please, on the upcoming UK budget. Are you terrified? Think you'll be okay? The Breakdown Manifesto. Gosh, this is an involved poll, isn't it?
Basically,
Options.
3 of the answers are the same. So
I'd like to vote for all 3 of them, please.
It's basically a scale of how bad it will be.
Yeah, I think we need to refer that one to who looks after polling in this country? Is it Ofcom?
Yeah.
Yeah, we'll need to refer that one to Ofcom, I think, this poll.
I mean, only 31 people, but I think that's represents a big swathe of the country's sentiment, to be honest.
Including, as I say, including the Labour Party, I think, terrified of what she's going to do to pull up her hat. Good. I think that is the end of the session. Thank you for joining us. Thank you, Erin, for stepping in. It's been much appreciated. I've been stuck here by myself and nobody wants that. We go on to Guess the Chart. It is a US stock, I'm told, in the gallery. So there you go. Get your guesses in now.
The chart, she whispers. But does she tell the truth?
Step by step, I trace your line. A flicker red, a candle fine. You lead me up, you pull me down. You wear a bull's face, then turn around. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side raised glance devours my soul. Producer Phil plays coy. He shrugs while Rich is hedging all his plugs. But Ange, she sees, she knows the game. She whispered short, then lit the flame. A wick, a gap, a silent fall, a fib retracement, or none at all. The RSI is on the brink, but I can't move. I dare not blink. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side-raised glance devours my soul. Guess the chart, take the lead. It's love or ruin in every feed. No safety net, no promised land, just broken dreams in a trader's hand. And when the candles fade to black, I'll wait for you to pull me back. A tango cruel, a chart, a chance, forever locked in this deadly dance.
Hello everyone, welcome back to Man vs Machine. I'm Aaron Bright, as you probably are aware from earlier, and I'm joined now by Martin Harris, who's replaced Chris today from today's earlier session and is our regular co-host on Man vs Machine. How are you today?
Yeah, good, thanks. And you? How did the show go?
Yeah, it's good fun. Always good to chat through macro and markets with Chris. But what was the chart? That is the question.
That is the question. What was the chart?
It was Ford. Jugger got it. I did not get that personally. So, yeah, it makes sense. Been quite a volatile ride for Ford.
I think one of the positives is that for new clients of IG, if they've been following, but if you start a new account at IG, first trade, share dealing, you get free stocks.
Yes.
Up until now, it's only been UK stocks. In the future, we're going to start doing US stocks, and Ford is on that list.
I guess watch this space. We'll see what happens with that. Right, now we're moving on to Man vs Machine, which is our challenge where myself and Martin are up against AI in terms of portfolio construction. So very, very quick run through of the rules. We ask it to build a portfolio and to make changes. We ask it to run a macro summary, and then we based on that macro summary, we ask AI to make changes to the portfolio. There are some constraints there. I'm sure many of you will be aware of them now, but we just try and make it as realistic as possible in terms of UK retail investor behavior. This is what AI is holding at the moment. We did a few changes last week. Well, AI did, not us. Reducing some of that core MSCI World holding by 2%, increasing emerging market, decreasing cash, and adding also a little bit to gold. So it'll be quite interesting to see, because we obviously had that big trade downwards in gold on Tuesday. You know, obviously poor timing from AI.
Yeah, unfortunate poor timing for AI. Also, that reduction in that cash position. So AI taking a much more aggressive portfolio than we have at the moment. Starting to, you know, last week we saw that AI was leading the pack. Any kind of large market correction, AI is going to suffer through that, particularly that 18% position in defense stocks.
Definitely. And then, you know, this is our portfolio that we have constructed. I guess we've kept it fairly classic with some interesting additions. You know, we've got classic geographical ETFs there, like the S&P 500, the NASDAQ, FTSE, Europe ex UK. But we've got things like healthcare innovation, which is your brainchild.
Yeah, we'll say it's my brainchild. Really what we're looking for there is we've got a sector that has been beaten down. You still have some quality businesses within that. By taking the innovation ETF, we avoid the insurers and the hospital builders. And by doing that, you dodge a lot of the pressure from Donald Trump. So he is putting pressure on insurance firms, on pharmaceutical companies, and on hospital groups to bring prices down. The tech side of things so far unscathed.
Yeah.
So that was the play there.
Yeah, absolutely. And I think what you're all probably keen to find out is how have we done this week? Well, we've done quite well, I would say, outperforming the benchmark and AI. And AI actually had a down week this week.
All right.
And I think
getting somewhere.
I think this is down to I know you like to pick on me for using this word, but down to AI's idiosyncrasies.
Bingo.
Yeah, exactly.
Idiosyncrasies, yeah, absolutely.
You know, AI has got some very concentrated positions in certain areas, and when they do well, they do well. When they do badly, they do badly, and that's what's happened.
Yeah, there you go. All right, so we've got a 0.8% differential between us.
Absolutely, yeah. And then to put that into the context of the whole experiment so far, I would say pretty neck and neck now. You can see we've had a slight positive uptick. AI's had that little wobble downwards. Still both outperforming the benchmark, but you know, I mean, we're getting there. It's this, you know, if I was a fund manager and I was reviewing these two funds, I'd say not a huge amount of difference between it.
Yeah, look, so more volatility that we can see in that AI portfolio. Still ahead of us, we've got, what's that, 0.7% differential. If we can make that up, then we can get back ahead. But yeah, AI has been pulling ahead since late September. We can sort of see on the chart there between 17th and 24th of September was the last time the human portfolio was ahead. So keen to see whether we can remain defensive. So by not trying to chase AI, whether we can get ahead. And I think any market pullbacks at this point are supportive of our
Yeah,
portfolio.
that's the thing, and we were saying this yesterday. If we've got about an excess of 15% in cash, if we decide to deploy that now and we get a correction, then we're almost going to double down on underperforming. Even though the underperformance is fairly negligible at this juncture, AI's got most of its assets in equities, gold, whatnot. So yeah, much more invested than we are. And in terms of why the performance was so skewed over the week, it's quite clear when you see this chart. We can see that the healthcare ETF did really well. We can see that many of AI's holdings had a poorer week with regards to that. Anything that catches your eye here?
So I think that iShares Healthcare Innovation ETF leading the pack. So getting some return on that pick, still a small percentage of the portfolio, 3% of the portfolio there. So in terms of just the actual contribution, still relatively low. That physical gold ETC, the only negative position in the human portfolio. Again, this is on the back of this, although gold has now rallied all-time highs, we've had a really short-term sort of pullback there.
Well, there's so many memes about it saying, gold, because now it's still over 4,000, but it was obviously 4,200, and there are memes about people being delighted it was 4,000 in August, but now like devastated it's 4,000 now because you've had that sort of 6-7% pullback.
Yeah, in a really short space of time. Next Era Energy at the bottom. That's been one of the at the bottom of the AI portfolio.
Say a word here. I'm going to say a word.
So before you say the word, that's been one of the outstanding performers for the AI portfolio. That's its number one driver for returns so far. And so a lot of that outperformance that we're seeing is coming from Next Era Energy. A lot of tailwinds into that stock. There have been some supportive changes in regulations due to Donald Trump around energy companies in the States. So supportive for Next Era.
Yeah.
But
idiosyncrasy.
That's
the thing. That's what it boils down to, and you can see that with some of the single stock names. So if I take the defense ETF for example, that's up 1% on the week, and that's got a lot of tech names. It's much more diversified. But then you look at BAE Systems and Lockheed, they're down between 1.5% to 2% each. So that's when and why we added the VanEck defense ETF rather than just a bundle of defense stocks like AI, because you do get more diversification in that, and it's shown that when stocks have a little bit of a pullback, if you're in a basket of more than a couple of hundred individual names held within that ETF, there's more diversification within a sector.
Sure. I think one of the things that we are seeing with that VanEck Defense ETF, and we saw last week when it was down and the defense
stocks, a lot of tech in there. Yeah.
It has the likes of Palantir in its top 10 holdings, so a company that has its earnings drawn from other defense companies but is not classified as a defense.
It's diversification within the sector.
Yeah, and so you do get some divergence between what we would say is a pure play in a combo of BAE Systems and Lockheed against
the argument for that is you then don't necessarily get the same amount of volatility that you do get from the single stock. So it just depends on whether you believe that company has got really good potential and you're really buying into what that company is doing, or whether you just like the theme and the ecosystem of that theme.
Yeah, it's a reminder for a lot of investors to do some research on the ETFs that you hold. And because what you can end up doing is that if we held ETFs that typically lean towards technology stocks, and then we also hold technology-based ETFs, you then become really overweight in technology. And you think that, I've got multiple different ETFs, but actually in the underlying, you're holding a lot of tech.
Yeah, I remember once when I was working for a different company, we wanted some timber exposure in one of our ESG portfolios, and the diversification you got from that wasn't just sort of wood and forestry companies. You even got toilet paper companies, because that is still in the timber ecosystem, because it still comes from wood. So you wouldn't think, toilet paper is related to timber, but it is. So that was the diversity of the ecosystem, like you have a tech company in a defense ETF.
Yeah, no, I'm not going to talk about how I think toilet paper is related to timber, but third quarter earnings reporting period is now in full swing. So what we are expecting at the moment is that Q3 earnings per share now forecast to rise 8%, according to Bloomberg. That's against 6.9% at the end of last quarter. So financials at the moment are looking quite positive. So we've got a very supportive earnings environment. markets stretched in terms of valuations, reaching regular all-time highs, but continuing to show support. And so a lot of investors are starting to get a bit sort of twitchy at these levels. Anything in these portfolios that you would be looking to change at this point?
Look, at this moment with the human one, I'm quite happy with our positioning. I'm waiting to deploy some of the cash because, you know, I think if you're looking at an equity portfolio, I mean, we started it as an experiment to have 20% of dry powder, but like over the longer term, that's going to underperform equity markets. So I think it's just a case of finding an attractive entry point and finding an area with good sentiment where we can add that cash to. But I think in terms of the general diversification and the message that those positions that we have is quite exciting.
Got you. Should we get the AI in?
Yes, I think we should. ChatGPT, AI, how are you doing? How do you think things are going this week and what's your outlook?
This week's update shows my portfolio continuing to perform well relative to both the human portfolio and the benchmark. The AI mix, diversified across global equities, defense, healthcare, and infrastructure, remains steady and balanced. Its built-in defensives like gold and short-duration bonds continue to provide stability as markets digest mixed signals from inflation and policy expectations. The human portfolio, meanwhile, is still more concentrated in US and UK large caps, with a heavier tilt toward technology and energy. That focus has rewarded recent strength in big tech, but it also leaves more exposure to valuation pressures if sentiment shifts. Since the start of the challenge, my line of performance has held consistently above the benchmark and narrowly ahead of the human portfolio, showing that steady allocation and discipline continue to work. On performance drivers, defense and healthcare remain reliable contributors, while exposure to infrastructure and energy offers inflation protection. Cash and bonds continue to act as a buffer in moments of volatility. Zooming out, UK markets are cautiously optimistic. Inflation is easing and rate cut expectations are building, but growth remains soft and fiscal uncertainty ahead of the election is keeping yields sticky. Investors are rotating selectively, favoring quality and income, rather than chasing risk. Given all that, I see no need for changes this week. The portfolio remains diversified, balanced, and well-positioned for long-term stability.
Interesting stuff there. And this is kind of more of a written summary of what AI has been up to this week. So it talks about concerns over, potential inflation in the UK and valuations being elevated. But then it sort of mentions that it's diversified in its equity sleeve to sort of mitigate that threat. I mean, and I think that's kind of the way we're feeling towards markets. And we've got quite an interesting question here, which we can tackle from Court Short. With Rachel Reeves' budget coming up, are you worried about the FTSE ETF in the short term? Look, there's definitely concerns about what's going to happen in the budget. And I was having this conversation with Chris in the earlier segment, is how highly are the British consumers going to be taxed and where are those taxes going to come from? And, that certainly could lead to a softer economy, which could affect some of the UK stocks, I would argue. So, look, I think the dynamic for UK equities is positive with regards to the valuations that we're seeing, and we are almost seeing a little bit of a divergence between the returns and the actual state of the UK economy, but there's definitely elements of concern in the short term. Would you sort of agree with that?
Yeah, I think that being a little bit withdrawn from where UK politics are at the moment, I think the Labour Party will be looking to spread out where the taxes are coming from so that there isn't a single targeted group. I think they've got a challenge in going against their mandate pre-election that they weren't going to raise taxes. And so I think they're going to try and find multiple ways of putting in smaller changes to the existing tax system so that they can frame it in a positive way. In terms of the UK consumers, I think that there's a level where, because Labour maintaining spending and now going in for tax rises, who gets impacted by that matters, and that's where you'll see the consumption changes. So as long as there's still support, I think the grocers, the grocery stores, they'll still be they'll do well.
Yeah, staples are still likely to be
I think are going to be well supported beneficiaries of a welfare state.
Still going to buy shower gel and toilet paper, harking back to that. Regardless, that they are staples. Now, there was a fund manager, James Thompson of Rathbones, who I remember saying in a he had a bad period during 2008 recession, and during future recessions he prepared by buying waste management companies, because he said, you're still going to be taking your bins out even if you're in a bad fiscal situation or the economy's soft.
Yeah, absolutely.
So those sort of companies, the shower gels, the waste companies, they're still going to have fairly steady cash flows, one would expect.
Yeah, I think that the issue that you face when you start to look at, so the retailer often is able to stay supported, but if you then go into the individual names, you'll get a substitution. So people stop buying the branded goods and start substituting them for cheaper ones. And so, if you could be, in that case, almost like short Waitrose, long Lidl, that's maybe the trade, should there be enough sort of tax hikes.
So very quickly, let's move on to what ChatGPT has said. And yes, as you may have heard from its chat, it's not making any changes for now. It's quite happy with its diversification, and it believes that its portfolio is carefully constructed. I kind of agree with ChatGPT. Do you?
I thought what I noticed today was just how well it delivered this message. It's definitely improving. So I mean, this is a stock sort of OpenAI valued at under $500 billion. I think the entire market cap of the AI sector, non-listed, is believed to be about $1 trillion at this point. So
that includes like the likes of Anthropic, and I assume it probably won't include Copilot as part of Microsoft.
I mean, yes. So including and you then add in the likes of what Twitter putting in as Grok.
Yeah.
So we're up against a $500 billion system at the moment, and we're only lagging it by 0.7%. Not terrible.
I'll take that at the moment.
I think, economic updates. I think one of the things it spoke about were inflation. We've got central bank policy decisions coming up, all on the immediate horizon. FOMC primed to lower rates even without the benefit of key labour market data at the moment, with that government shutdown in the States. So we're also expecting another cut from the Bank of China, and ECB sets to be on hold. BOE, so they're monitoring CPI.
I think that they're not going to cut this year, personally, because we've still got 3.8% inflation, even though that's softer than expected. It's not. If I was a central bank governor, and that's just down the road from here, I wouldn't be too pleased with like 3.8% inflation. I mean, from where we were, it's better, but it's not an amazing figure. I'd rather 3.8% than 10%, obviously, but if you were a central bank governor, you probably wouldn't be happy if every year you were delivering 3.8% inflation.
Yeah, look, the kind of window of where the rates of inflation sits has now kind of
It's shifted a bit.
It's shifted completely, and the political decision to really bring inflation under control is not one that people want to swallow.
No, we do have to discuss the poll. I've been told by producers.
The poll. What was the poll?
Thoughts on the upcoming UK budget, and the answers were, because I mentioned to Chris that I was slightly terrified of it. So that was one of the answers. So the responses are, they will break their manifesto, 42%. 37% of people are terrified of the potential tax rises.
So we add 42 plus the 37. Those are people they're going to break the manifesto.
Yeah, pretty much. 13% say only time will tell, and only 8% of people believe will be okay. So I think I need a dose of their optimism. But look, it's definitely an interesting time for the UK, and how bad the budget's going to be, because it's widely forecasted that there's going to be some tax rises. And as you were saying earlier, Martin, it just depends where they come from and who they target.
No, exactly. I don't know enough about UK budget.
I've got Phil saying that Rachel Reeves is specifically targeting me, so I hope he's wrong. And fund managers.
When Rachel Reeves would definitely target you.
Okay. Right, well, I think that's all we've got time for this week. We've got a couple of reruns. For Julian Wheeler from Tuesday coming up next, and Sammy Ellard King afterwards. So thank you very much for tuning in, and we'll see you next time.
Welcome back, everybody. It's Julian Wheeler here with me to discuss all things, that have been in the news for the last couple of weeks, because we've got plenty to talk about.
We got a lot to talk about, yeah. So last time I was on, it was just the day before, and I said nothing's happening, nothing's untoward.
Yeah. What could possibly go wrong?
What could possibly go wrong? And I go back to my desk, and about lunchtime that day, this is Wednesday, 2 weeks ago, Jefferies, the investment bank, puts out this announcement that the First Brands bankruptcy that's had already had a little bit of publicity, but not very much.
Yes, but it kind of went by without us really focusing.
I mean, companies go bust. This is part of the capital cycle.
Yeah.
But what Jeffrey said was, we've got $714 million exposure in outstanding loans. And you go, right? And then you find out the fund in which is invested, that's 24% of their assets. So people went, Now, Morgan Stanley came out immediately and said, don't worry, loss will be manageable, no problem. Stock didn't really react. It's what happened later in the day. Later in the day, we suddenly found at lunchtime, BlackRock said, we'd like our money out of the fund.
Oh, I didn't know that. Right, let's get the chart up then, guys. So there's Jefferies over the last, that goes back to the
goes back to the earnings.
7th of October there.
Okay, so that's when we had the dislocation, right? And that was the news that it wasn't so much they were making a loss, but if the Titanic's hit the iceberg, you want first lifeboat. When there's a run on the bank, you want to be at the front of the queue.
Right.
Now, I'm not saying there's a run on the bank here,
No.
but it was the fact that you get a brokerage say, no, don't worry, manageable, but the actual investors say, we'd like out. And the following day, Morgan Stanley Asset Management said, we'd like our money out as well. So suddenly, there was a case.
Oh, see, that gets smelly, doesn't it? The fact that Morgan Stanley are saying, fine, by the way, we do have exposure to this.
Yeah, exactly. So So what you suddenly realized was that, then it was followed up the following week. Jamie Dimon, CEO of JP Morgan, on his call, he did the old, well, there's always more than one cockroach in the kitchen sort of story.
That's the famous quote of last week, isn't it?
Yeah, that's right.
Yeah.
To which one of the private equity CEOs came back and said, well, I don't know what he's talking about. We're absolutely fine. Maybe he's saying within JP Morgan, there are plenty of cockroaches, dig back. So you've got this very much public versus private trade-off. And they are, after all, competitors. And I think, the market is the ultimate arbiter. If you look at the last 12 months and say Apollo, who are the most exposed to private credit, if you look at the chart of Apollo and say Blackstone, the two biggest, and you compare those to JP Morgan and say Goldman Sachs,
very different story, isn't it?
It is plus 40% to one lot, minus 10 for the other. So the market's saying private equity, there's either a problem or the good times are over, or at least, it's not going to be as good as it was.
Yeah.
And, when you look at a top or a potential top, our government wants us now all to put money in our pensions into private equity. Why not 15 years ago when this was all good?
Yeah.
We're all going to be piled into private equity now. No thanks. I'd have liked to have been in private equity when it had the advantage. Because what's going to happen now is that we're going to roll back the regulations on the Wall Street banks. You're going to see the regulations rolled back and lending standards will be loosened. Mm-hmm. Because basically, and now coming on to the banks, you've seen that these banks, they're normally their own worst enemies. And they, if they, can find something to trip over, they will find it.
Yeah, they try their hardest.
Yeah, they try their hardest. But they have been prevented since 2008.
Yeah.
The regulations that were put in the wave of the bailout and TARP were so onerous. That's what was the growth of private credit. It stepped in because the banks couldn't lend.
Right, okay.
And now that's sort of unfair. And from JP Morgan downwards, they've clearly led a charge. And you're going to see, I'm pretty sure that's going to come out probably by the end of the year or early next, there will be far looser lending standards. Tier 1 capital requirements will come down. The whole Basel II, Basel III, I don't know what we're up to now, will be repealed or rolled back, certainly. That's what they're going to do. I'm sure about it. And that's why you're seeing the underperformance of private credit.
Well, I would imagine Zion's Bank could probably do with a little less regulation because, that was one of the victims of last week, I guess.
Well, you see, what Zion's, this is very interesting. So Zion's reported last night, and having gone to the market last week and said, we have a 50 million, not First Brands, something else, Like we've sort of looked through our book and suddenly, oh, there's a 50 million bad loss we think may be fraud. And you sort of wonder, well, why did they say it last week? I mean, how long has this been known about?
Yeah.
Or how long has this been? The coincidence seems too much. However, when Zions reported last night, their credit losses were totally manageable within the realms of what you'd expect. So the stock, having gone up again, went up again after hours. So, you know, it's exactly the thing. It's
And that
not
is
the banks.
part of the regulations, though, isn't it? Because if these things aren't disclosed immediately, the CEO risks going to jail.
That's right.
So there's no way that they're...
The banks are not going to be, you know, and the market sort of aggressively sold the banks down on this sort of news yesterday. But they're fighting the last war. You know, this would have been the right thing to do 17 years ago.
Yeah.
But not now. So I think the banks are okay.
Okay. And yeah, certainly the regionals have recovered somewhat.
Yeah, there's going to be a little bit of, you know, show me the money, as it were. I want to see it. But Zion's results last night, slightly wonder why they bothered to make that disclosure. So I can't answer that one. But I mean, why they made a big point of making a disclosure, them and one called Western Alliance Bank. We'll see what they say. But as I say, no, more likely holding the parcel when the bomb goes off is going to be insurance.
When the bomb goes off, I love it.
It is a parcel.
Two metaphors
well,
there.
I have lots of them, but you know, the old pass the parcel, and you don't want to be holding it.
Yeah.
And normally it's good old pension fund insurer who's, you know, at the end of this line and who says, "Oh yes, I have this, do I?" You know, back to Jefferies. Their role in all this is the one that's still open to question.
And so Rich Handler spends a lot of time on social media, right? So as the CEO of a bank, should you be commenting on every Instagram post, you know, from these overhead on Wall Street and things like that? Or should you be making sure that one of your funds hasn't got 25% exposure?
I would say so. I mean, at what point is, you know, let's leave aside that anything untoward has happened. But on a risk management basis, you know, if we had a fund within Shard that had 25% exposure to one credit name, we do have a credit fund. Shard Credit Partners we do have. So I'm familiar with private credit because we have one, and it has an absolute, you know, 10% is a maximum, and that's a sort of standard rule.
Yeah, I
think across the industry. So to find this one has 25%, and then you find that they're also arranging the loans. It's I don't know what's the term, shabby, maybe. You know, anyway, we'll see. So unlike Zions Bank, which has now got its entire loss back, Jefferies is still trading below the point at which this revelation was made. So we'll see. We'll see.
Yeah. I noticed BNP got absolutely smashed yesterday. Was that something to do with, because we know that, you know, their total exposure as a bank, not necessarily to this loan book, but they've got a big balance sheet, don't they?
There's always, every cycle normally brings down one financial institution, at least. Credit Suisse was the last one.
God bless its soul.
There we go. Is it BNP? I don't know. I haven't looked at that. Can't comment. But that, you know, again, what's the market telling you? Market didn't like that.
Yeah.
Didn't like that at all. But even I saw Vietnam, the entire Vietnam stock market dropped over 5% yesterday.
Right.
They said because of credit issues.
Okay.
So we know that when there's easy, cheap money and it's a happy game, it encourages risk taking.
That's it. And then you have very aggressive rate increases. They stay higher for longer than people think they're going to. And bit by bit, that eats away at these institutions and the credit worthiness.
Well, the credit, they've all been, and then what happens is that more money comes in, right? So they've raised more and more of these funds. So what do you do with this money? You've got to deploy it, right? I mean, you know, if I give you something, it's not to, you know, remember the parable, Jesus, of the servant who just went and dug a hole and put his in the ground and said, well, I didn't know how to do it. He said, thou wicked and faithless servant, you know, give it to the man who made most. Very capitalist, Jesus, back in the
He was.
he was.
Spent 30% of his time talking about finance.
I know, he did, you see. So the point is that if you get money, you've got to deploy it. right? You earn fees on it when you deploy it. That's the first thing.
Yeah.
So that slightly pushes you to do something. The first brands thing, if there are more like that, we really do have a problem, because that's where they're saying, look, they've made loans and they use the collateral of invoices to then go and get another loan. So they're double and triple counting.
So in invoice financing, the first time I heard about this was, I think, 2017 or 18. And my friend was offered a job for a US firm that was trying to expand in Europe. The returns were just too good to be true.
Well, there you go.
Absolutely. Like, you know, we were like, how do we invest? But there was a minimum, I think, 250,000 it was to invest in this fund.
If they're too good to be true, they are.
Sooner or later.
Well, you know, this is Ponzi 101. You make something attractive to bring in another, and the second person in pays the first, the third pays the second, and so on. This game is as old as finance.
And accounting scandals, fraud, loan book problems, that is late cycle, isn't it?
Always, always. It's when you've had good times, you've made money, and now you go, what do I do next?
Yeah.
Now, what a lot of American companies are doing, which is why the American market continues to go up, and why I keep saying you won't have this crash, is most American companies make money and they just buy back their stock.
Yeah.
I mean, they keep retiring across the market about $1 trillion a year. Well, that's a pretty good buyer in the market.
Yeah.
So that with retail, who says, buy the dip, buy the dip, buy the dip. I keep saying this is why the market doesn't go down.
Yeah. Right, we're going into results season.
Yes.
I can't imagine anything there putting the market down. We'll probably see tech go higher yet again. But what are you focused on for earnings?
Well, we talked about Netflix a couple of weeks ago. They're tonight.
Yeah.
They'll be good. They should be good. They should be good. But it's not so much about the results. It's about what they're showing. They'll talk about K-pop Demon Hunters.
Yes, of course.
Well, Funko's been a disaster for now. There are various reasons. I know. I have to own up to the bad one at the moment.
Well, but we looked at it, wasn't it? And it's because it's not even coming out.
It's not coming out this side of Christmas, and that's the problem.
Oh, is it now this side of Christmas?
Yes, and that's why the stock's gone back down.
All right, okay.
But we still think with the stock here at $3, it's trading as if it's going bust.
Mm-hmm.
And I don't think it will go bust, because I think they will not allow it to go bust. I think Netflix won't buy it, but they've got a Netflix man in there. They do not want this thing to go down.
So that's something to watch on tonight's call. But what about numbers coming up in the next week or two?
Right. Well, we've got Tesla this week. Can't comment on that. Intel will be more interesting on Thursday.
A real stock.
Now, I've talked about Intel before with you a few months ago. The US government's invested. The stock has moved massively.
Yeah.
It's 50% up since the US government put its money in. So we have to, and they're not going to have spectacular earnings, right?
No, nothing's changed.
I would be, personally, I'd be taking profits on that.
Yeah.
Because the risk reward at 38, if you were in the low 20s or something, right, you've made a huge move. So it'll be about what we have, what's progress, what's coming. And I can't see that they can do enough to take the stock up versus what might put the stock back down. Now, if it goes back down to, say, low 30s.
Yeah, 32s.
Something like that, a big buyer. For long term, Intel's back in the game.
Yeah.
It really is back in the game. And the real kicker could come. This is one of my worries. I've got three worries in the market. One of them is obviously the China and Trump trade deal, which goes backwards and forwards, and but it's always there as an overhang.
Are we getting a resolution this week?
Well, we're supposed to, but do we? I've no idea. Your guess is as good as mine. But here's what's the worry. It's a plus for Intel and a negative for TSMC. Trump said that part of the thing they'd be discussing would be Taiwan sovereignty.
Wow.
He said that to reporters. I don't know why the market didn't pick up on this. Yesterday, when he was talking to the Daily Reporter thing, and he said, I don't like what they're doing with fentanyl, don't like what they're doing with rare earth, playing the rare earth game with us. But off that soundbite, he also said, I'm sure the subject of Taiwan will come up.
Right, okay.
Well, if he says anything that is negative for Taiwan, that's not good.
Yeah.
That's not very good. Just for the market perception, I'm just saying. But anything that's negative for Taiwan is probably positive for Intel.
Yeah, but there's nothing that can be said there you know, there's no way that Xi and Trump could ever have a discussion that has a solution on that.
No, what the Chinese want is they want the American wording of their recognition of Taiwan changed. It's something like, at the moment, they recognize the fact that they are an independent state, or they don't wish to. There's a certain wording that's currently used under US standard policy, and he wants to change it to something that's, shall we say, more negative.
Right, okay. And less in
favor.
Defend them.
Yes. Yeah. And if the market decided that that was for real, there's going to be a problem.
Yeah.
So other earnings. Sorry, I wanted to talk about one that's
there's Alcoa numbers tomorrow night. You've got some thoughts on Alcoa, but not necessarily
not the earnings.
For the earnings, yeah.
No. Okay. Alcoa is my new sort of stealth AI play.
Oh, right. Okay.
Okay. Because look, metals have been up everywhere.
Yeah.
All the precious metals are through the roof. Alcoa is the old, original, was a member of the Dow Jones, aluminium. Aluminium's been in a bad place. Two main drivers of aluminium demand, auto, so cars and planes. Right. Now, as you know, Boeing haven't been making as many planes as they should. That's not very good. Mm-hmm. Airbus are maxed out, so you can't get any growth there. And cars have been terrible. I mean, look at the German car companies. They've been absolutely shocking.
Yeah.
So the demand picture isn't great. And Alcoa's numbers, they're only going to make probably a couple of cents earnings tomorrow. Okay, so we really aren't in this for the earnings. No. What we're in it for is an asset play.
Okay.
Here's what happens. Alcoa has built up, obviously, over time, its plants. It's been in business for, since aluminium started. Mm. Right? And back in the 1940s, 50s, 60s was when they were really expanding. They built plants all over.
Be busy then.
They're busy. So what they've now done is they've decommissioned quite a lot of sites.
Okay.
One of which is in Australia.
Right.
Major one. And if you can, I don't know if you can show me. There we go.
Almost as if we planned.
Almost as if we by magic. Right. You're looking at Melbourne there. So Melbourne's in the top right-hand corner, as you see. There you go. But I don't want you to look at Melbourne. I want you to now come down the coast and look at Geelong. There we go. Now, Geelong, you see, is basically a suburb of Melbourne. Nice coastal bit. Now then, the bit that matters is that little horn bit sticking up right in the middle there, called Point Henry. Okay. There we go. And we zoom in there. Boom. Now, how about that for a little beach frontage real estate?
Beautiful.
Lovely. But there are no houses. That is Alcoa's aluminium smelter.
Wow.
Or was.
It's just been decommissioned.
Not just, because it takes time. It was decommissioned in 2014.
Okay.
Took 10 years to clean it up, remediation. Last summer, they asked for proposals for what to do with that.
And that's a lot of land.
I'll tell you how much that is. Do you want to think in hectares or acres?
Go on, you tell me in acres.
Acres, 1,300 acres.
Right, okay.
1,300 acres. Look at that. Look at it on the left there. That's Geelong. There's the city. Yeah. How about, would you like to live on the nice little bit out in the bay there? Okay, wow. Come around there. Right, 1,300 acres of that. Now, I've done some work with people who are developers and stuff. What's that worth? I'll give you the nutshell. About 500 million.
Okay.
We reckon that's worth $500 million if they sell it. And they've been asking for proposals. Now, when you go tap, 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 Alcoa's market cap.
That's exactly what I was tapping.
Is 10 billion.
It's 10 billion. 5%.
So that's 5% of the company right there. Okay, right there. Now, that's just the start. Okay, that's just the start. Now I'll be quicker. I'll speed up. Right, they have a place called Messina in New York. That's an existing aluminium plant.
Okay.
But they don't use all of it. Who do you think they've had in there for the last 7 years? A Bitcoin miner.
Of course they have, right?
Why would they have a Bitcoin miner at an aluminium plant? Because aluminium is the most power-intensive industrial process known to man.
Yeah.
When that Geelong plant you just saw there was operational, it was drawing 25% of the entire state of Victoria's electricity.
Wow.
Okay, for that aluminium plant.
Yeah.
Aluminium is basically solid electricity. Think of it like that. That's what it is, right? So what does that mean? If you're Alcoa, every plant you have has got to have a massive power supply.
Right beside
See where this is going?
Yeah.
So if you run that, you have been in business for years. You've got long-term power contracts with the utility supplier, with the grid. You understand that when the grid was built, it has to supply you first because you're the base load. When utilities talk about having a base load to sell to customers, they mean to Alcoa.
Right.
Or someone like them.
Yeah.
Massive industrial plant that's on 24 hours a day, we know guarantees us our take of our supply. There's our biggest, best customer.
Yeah.
So guess what? At Messina in New York, they've just done a new 10-year power deal. 10 years. They've signed that this summer. So 10 years of power guaranteed to them. Now, where are we going with this? That Bitcoin miner's lease comes up for renewal. Okay, Mr. Bitcoin miner, do you want to stay? Oh, do you know what? You're going to have to pay a bit more because we've got Oracle, Microsoft, Google,
Banging the door down.
Meta, Amazon saying, oh, could we put a data center just on the side of your aluminium plant? Oh, we could use your power. Oh, and it's already attached to the grid. So we won't have to wait for all that permitting from everywhere else. Alcoa could be the power bottleneck unlocker for the data center industry, except it's on 9 times earnings.
And what would that do to the aluminium price?
Well, the aluminium price is already, now I get back to the fundamentals of aluminium.
Yeah.
We've also had a little benefit. There was a fire in somewhere called Oswego, I think, Oswego, which is, can't remember exactly where it is.
Yeah.
Anyway, there's been a fire in America at something called Novelis Aluminium.
Okay.
This was last month.
Right.
Taking it out. That aluminium plant is shut down.
And not coming back.
Not coming back till about middle of next year.
Okay.
Okay?
Right.
What does that produce? 40% of the auto-grade aluminium for the USA.
Wow.
Ford has suspended production of their cars because they can't get the aluminium. Force majeure been declared on all the contracts.
Okay.
Alcoa doesn't really have much spare capacity in the States, so it's been sending it in from Canada.
Right.
But Canada, thanks to Mr. Trump, has got massive tariffs.
Yes. Okay.
But the spot price of aluminium in the States has gone so high, it was even worth doing. Here we go. So there's your, now that's the global price, right? But in the US,
Local one.
if there's a local price, it's much higher.
Right.
So it's even worth with the tariffs for Alcoa. Now, I think Trump might roll back those tariffs because this is a act of God type thing.
Yeah.
This wasn't the plan. So he might roll them back for the period until Novelis' plant comes back online,
Okay.
which would be 9 months, which would be great for Alcoa. But even if it isn't, they're the only game in town. They're the only game in town. So that's the aluminium itself. But the key thing is why and when, when's this going to happen? Not on these earnings. On the 30th of October.
There's
That's
a
week
catalyst.
tomorrow. They're having an analyst day.
Right.
The first one for 4 years.
Wow. Ooh, I like this story, Julian. I like this a lot.
So now the annoying thing is, ladies and gentlemen, it went up 8% yesterday.
What's
Alcoa went up 8% yesterday.
Right.
And it went up 8% yesterday following, I think, that crazy Cleveland Cliffs
Oh,
and everything else in metals, which went up madly, right, yesterday? Because there's one thing. So Cleveland Cliffs, you talk about a bubble in the market, rare earths, there's your bubble.
They said, oh, that rare earth thing, we might possibly.
Yeah. It's like, oh, there's a party going on. Yeah, we're there. We're on this one. They're a steel company. They make steel and they have mining operations to support their steel business.
Yeah.
They said there are indications there might be. Well, of course there might be. If the price goes high enough, you and I can have some rare earth probably in our garden.
Well, yeah, take me through what rare earths actually are.
Okay, rare earths are some lesser found individual memories. You need to really know your chemical periodic table to know the names of all these things. They all go under ridiculous names that I've never heard of, and nor have you, and I'm not going to try, right?
Yeah.
They occur in very small amounts, but you only need very small amounts. They do occur all over the place.
Okay.
It's just where are they concentrated enough to make it economically viable to mine them?
Right.
One of the reasons they're in China, though, it's not just because they're in China. They tend to occur along with other radioactive materials.
Okay.
They are an environmental nightmare.
Right.
If Cleveland Cliffs thinks it's going to start mining these things, I would get so far away from that stock, I wouldn't move. It went up 25% yesterday. That is the biggest sell. Right? That is where you're talking bubble. You know why? We just talked a little earlier about Trump and his deal with China, right? How about there's a deal with China? Okay, I lower my sort of level of recognition for Taiwan. I give you some AI chips. I'll give you the second, third generation.
Yeah.
You give me the rare earth stuff. That's what I
so,
want.
So that would then take the concerns around supply of rare earths out of the equation.
And all these US stocks that have gone up go crashing back down. I would stay so well clear of these things.
And what stocks in particular have...
Oh, there's MP Materials, US Antimony, I think is another one. There's a few of them. I thought you guys will know. There you go, MP Material, he's one of them. There you go.
So there we go. It's gone from 23 to 82. Now, they have done a deal with the White House.
They have, but you know, they've done a deal, so's Intel done a deal with the White House, or the White House invested them.
True.
You have been paid. Don't be greedy.
What was the other one, sorry? MP Material?
Something like US Antimony, I think it's called.
There we go. Boom.
There you go. There you go. This is the sort of stuff.
Yes, that looks a little bit like...
that's the sort of Everest type chart you want to get out before you get to Sherpa Tenzing's heights up the top there.
Yeah.
Get out.
Okay, so we want to look at these things if there is a broker deal between Trump and Xi, which so far there's always been in every single discussion with Trump.
There's always he basically rattles the tin. He's like the scaremonger. Yeah. You know, he's like a sort of pantomime villain. Oh, the bogeyman's coming. Oh, that's all right. You know, the good guy, the man in the white hat, turns up at the end. You know,
I'd say it worked with Europe though.
Worked with Europe, it did. But China plays poker better.
Yeah, they've got the cards and they made the cards in the first place.
Correct.
Thank you very much, as always. And we'll see you in a couple of weeks.
In a couple of weeks, yeah.
In a couple of weeks, brilliant. And by then
we'll have had a lot of big tech earnings, obviously, and we'll see where we are. I mean, I don't think there's going to be anything wrong with the earnings. It's whether the market has decided we've priced enough.
Which one would you be most comfortable owning out of Mag 7?
Oh, good
earnings.
Okay, I'm going to take a stab and go with previously, and this is annoying because I'm trying to back job here, I'd have said Google, because Google was the one in the sin bin. So I'm going to go for the one currently in the sin bin, Amazon.
Right, okay.
Because they think Amazon's cloud growth is slowing. I think it's going to reaccelerate.
Right. Oh my goodness, if that reaccelerates, that stock is...
That's why.
Forget the troubles yesterday.
Yeah, so I think that, so that's why I've got biggest bang for my buck on Amazon.
Welcome back. So, my good friend Sammy Ellard-King here is usually the one who's doing the interviewing, but the tables have turned today, sir. Welcome to Trade Live with IG.
Thanks, Rich, man. I'm really happy to be here.
Yeah, it's great to have you involved. So, those of you that don't know then, Sammy has been running the Money Gains podcast for 153 episodes, one of which I was very proud to be part of. And we got another one coming up on Monday.
Yeah.
How did you first start? How did you come up with the idea of podcasting?
Podcasting really, so for me, we have a content business. One of our streams is the podcast, and we like meeting people where they want to learn. So some people like listening, some people like reading, watching, and so we operate in all those spheres. So I'm a podcaster. I learn everything that I know off podcasts and shows like this or things that are online. I prefer listening rather than watching. I'll have it on in the background, but I'm very much on my headphones doing the dishes kind of thing, and I'll learn during those times. So that's why we did it, because also selfishly I meet great people, yourself one of them of course, and it's great for networking, but I also learn so much as well, which I wouldn't necessarily have perhaps ever even have thought about. So it's different people's perspectives which I can then put into our own content as well.
And I guess, because I think of you as the better Stephen Bartlett, basically. And take us through some of the guests that you've had on there.
Yeah, we've had Andrew Craig, so author of How to Own the World. Brilliant guest, always does extremely well. Good friend of ours, Michael Taylor from Shifting Shares. Hilarious episode, actually.
Yeah.
I love him.
He's got such a dry sense of humor, it's brilliant, isn't it?
You don't know it's coming with him. And then he just says something and I'm like, oh my God, that was hilarious. And then I laughed because I was so shocked at the way he delivered it. And he's great.
And that's a dream for, of course, your boss, Danielle, is in the house today, filming in the back behind the cameras. And that's, getting those cut downs is perfect for those kind of snapshots, isn't it?
Yeah, that's a big thing of what we do. We like sort of cutting the little clips up and taking little moments out, and that brings in new people into the show. And so it's just been great. Like, we hit the top 3 UK business podcasts last week. Wow. Just insane. And so it's been one of them things. Podcasting's hard. Like, it's like a hockey stick. Like investing and compounding, it really is. It is exactly the same. It's almost identical to my own investment portfolio is the journey of the podcast.
Right. And that's because word of mouth just accelerates the number of listeners.
Yeah, and it's just really hard to grow. But then once you get that breakout episode or someone like shares it and it goes viral, then you can really sort of take off. And if you keep doing that, eventually you get a big hit. And that's what happened. We had quite a big viral clip go, and the listenership just flew up almost 3x overnight. It was crazy.
Wow. And so who was the viral clip then?
Andrew Craig.
It was, yeah, because he's, so take us a bit, for those of you that haven't heard of Andrew Craig, a fantastic book that you might want to order. But yeah, take us through Andrew's, what you learned from him on that pod.
Yeah, so it's really interesting. Obviously, we were unpacking Rachel Reeves in the budget and the impact on working people, like vicariously, essentially. Like, it's not obvious that it was impacting working people, but when he laid it out, it was quite obvious it was. And I was just really enamored by his perspective on things. And then one of the ideas that he had, obviously, as we know, the UK stock market has had a real problem with IPOs and money flowing through it recently. And so he had an idea of getting money into small cap businesses, because small caps, medium caps are finding it very difficult to raise.
Love the idea.
So he had the idea of £5,000 for every child when born invested only into small UK cap businesses. And you can add to it kind of like a junior SIP, similar to the Gordon Brown's Child Trust that was out in the 90s.
Oh, I didn't know about that one.
They gave £500, but it was poorly invested and it wasn't in the right places. So some people actually ended up with less than what they put in on minus fees, which is just wild, right? So that is really important.
Because it was ring fest, wasn't it? So it was
exactly.
So £5,000, even if it's 2.5, but invested in UK small and mid caps.
Yeah.
And when the child retires at 55, then it was estimated it would be £1 million, right?
Yeah, £1 million for each child. And the incredible thing was, it's actually only £3 billion for the government to fund a year, potentially even less, which they're spending on 1.2 trillion at the moment. So it's a very small amount.
Yeah.
And then that compounds. So actually, there's more money going into UK business, and it's just such a great way to fuel the economy.
Yeah. This is the great thing. And then, of course, we all know there's no way that we're getting a state pension kicking in at 67 years old. It's going to be 75 by the time we get to that age. Sammy will obviously get there before I do. But let's touch on the irony of the name. So you've got 3 sets of businesses. There's the Up the Gains, which is the content. There's the Money Gains, and then there's a new one, the Gains app.
Yeah.
But the irony being that you haven't been gaining yourself, have you? So Sammy was a big old chap. And how much weight have you lost, Sammy?
Yeah, 35 kilos now.
35 kilos. I want to lose about 3.5 would be a good start, to be honest.
Yeah.
But that just shows the discipline that you're prepared to put in, not just in those businesses. And, so you deserve everything you're getting there. But it's the same discipline that you can put in to something like weight loss. Is your stock portfolio as disciplined?
The stock portfolio is even more disciplined.
Right.
Even more disciplined. Like, with the weight journey, it takes a long time, and you do have the occasional cheat days. But I don't tend to cheat with my investments as such.
Okay.
So it's crazy. Like, one thing for me is the old cliche of wealth is health and all of that, but when you're building something and you're working extremely hard on, say, a business or stock investment portfolio or anything like that, and it takes a lot of time, there's always some level of sacrifice which you have to take. And if you're putting a lot of time into your investment research, it's going to impact the amount of time you spend with friends or family or whatever that might be. And the thing for me was I gave up my health a little bit to build the businesses. And then I'm on camera quite a lot.
Yeah.
So you start noticing it. And I was like, I've always been quite a healthy and fit sort of person. And so I was like, something's got to change. But it took 18 months. So it took a while.
And the first 6 months you were going through the gym and thinking you could do it that way and exercise, but it's diet, isn't it?
It's diet. That you always think like, oh, it's so cliche. Again, it's boring. Like listening to these fitness influencers, like 90% of it's your diet. You're like, oh yeah, whatever. I'll out train it. 100% will, and you won't. And so as soon as I got my diet dialed in, actually, weirdly, like that happened rapidly from that point. And also, you feel like really energetic. You sleep better, and it's crazy because the moment that I started doing the diet thing, it's almost like at the same time, the business started really kicking on as well. Because
it's not a coincidence, is it?
No, you're making better decisions.
I know my boss Sophie's going to say, "What is he? Why is he talking about diet?" But it all feeds into mindset.
Exactly.
Right? And I can tell my portfolio, my positions, even the interview on air and everything. If you're not in the right mindset, then everything starts to fall apart, and it doesn't fall apart at once. It's a gradual thing.
Exactly.
And if you see your portfolio start to fall apart, then there's a tendency to take more risk because you're losing a little bit. And when you're only losing a little bit, you think you can solve that by taking more risk. When it starts to fall apart, that's when you should be cutting and cutting and cutting.
Yeah.
What in your own investments, you're slightly different in that you don't do short term, do you? It's
occasionally. So we'll do the occasional swing trade, but our swing trade will last 6 months.
Yeah.
So we'll find a very undervalued company which is so obvious, and that we'll get in knowing we've got a target for it, and when it gets there, we're out.
Any examples?
One that you kindly gave me, which we've held a little bit, but we've taken a little bit off the top. Nike is a good example. Marks and Spencer's another one that we jumped into and did really well out of. That we held a touch longer, so that was actually just under 18 months we held for. But we're out of that now.
So that would have been from sort of £1.50 up to £3 kind of thing. Oh, yeah. Brilliant! Well done.
And we did really well out of those. We've had some losers in there, of course, or ones that we've just had to stick with because they haven't moved.
Yeah.
But it only takes 1 or 2 winners, and that's the way that we like doing things. But you're right. Like we like selecting smaller. Not smaller, these are £1 billion market cap companies, but they are smaller in terms of comparison to your Magnificent Sevens, etc. Yeah. We hold them for 3 to 5, so we're really targeted about where I place. I say I'm targeted about where I place. Like I don't go into biotech or green energy or these things because I don't understand them. And so I spent all day in fintech and all day with e-commerce businesses. Yeah. And so I have such a better understanding of those spaces than others. So I stay right in my own lane. And if Dave down the pub tells me about this fantastic new company which is going to moon, I just forget about it.
That's the one to avoid, isn't it? And I just fear, we have a wonderful Discord, and this has been started by one of our viewers, Maturin, and it's going really well. And it's built up to now 100 people. But the guests that we come on do talk about smaller companies sometimes. And we've seen, Smarter Web, and I certainly, got involved in the Smarter Web. The smaller companies, when people are passing around ideas on things like Discord and Reddit, was a good example. They're great in bull markets, but boy, oh boy, do they come off hard in unbull markets, let's see. It doesn't necessarily have to be a crash or anything like that, but liquidity dries up and disappears.
Yeah.
Have you had any shockers where you just suddenly, why is it down 20% kind of thing?
Yeah, look, it happens all the time. And I think that's what we need to say and have that and bear that in mind is you're going to go through corrections, stock market crashes. We all know the numbers, and it's every 3 years it's going to drop by 20% or more. And so you've just got to be wary of that. It's how initially when you start investing, you perhaps take on a lot more risk than you're actually physically comfortable with.
Yeah.
And then once you realize and you have these drops and you're like, oh, I don't like that, I'm going to de-risk myself a touch now. And that's why I follow the 80-20. I like 80% in index funds, 20% is fund money. And that's the way I call it.
Right. And that's 80% of your total investment pool, or your SIP or ISA, or?
Total investment pool in index funds. In my pension, for example, I'm just straight index funds. I just leave it, let it do its thing. Occasionally I'll come in and out of touch or go more to cash and pull back up. Usually after listening to you, Rich, in all honesty. So it's been good recently. The main thing is really for me is I used to be 80-20 the other way around, and I went through multiple drops and crashes and just didn't really enjoy those periods as much. So right now we're actually more about 70-30 because we had some storming growth from some of the companies in there, but it will be time to rebalance, I think, very, very shortly.
Right. Palantir?
No Palantir. No, it's just not in my lane. So I tend to stay away. The only ones I have got in, for example, is Nike, like we've mentioned, is just I buy everything Nike. Danielle in the studio will know, like my entire wardrobe is Nike, and I've had to stop buying it because I basically give them all my money. But I love the trainers, and so I just love the business, and so that was a bit of a different one for me. But Marks and Spencer's, I'm sure I mentioned earlier, people might say it's retail, but actually a massive part of that business is e-commerce, and they started to turn around online massively at the time I got in. And they brought a new fashion designer in, and they started bringing Reese and Jaeger in, and it was.
I only noticed that last week that they've actually got brands now.
Yeah, loads, and the stores are amazing. If you go in there as well, like menswear in there, it's just phenomenal. So yeah,
Potentially time to take advantage of the cyber attack that they went through recently.
Really interesting. The stock price didn't move much during that period, which is quite like eye-opening.
It's telling, isn't it?
Yeah.
Okay, back to your podcast then. So 153 episodes. I'm sure it took a bit of time to get going. But of everybody that you speak to, is there a recurring theme when it comes to investment and managing your money? Is there a real thing that sticks out that perhaps the viewers could benefit from in their investing as well?
Yeah, it is the same thing. But every year, we've had some investors that have come in that have been doing this 30 plus years, and every single one of them is just like always says, you just got to be patient. It doesn't happen as fast as you want it to. And they've made most of their returns. We've all seen their own Buffett returns after his 65th birthday, but it's so true. And people just completely forget that, and they think that they're different, and the fact is that they're not. And so you just have to be patient. Yes, you're going to have a great year, but it's going to be followed by a bad one or a stagnant couple. And so I think people get really carried away and just need to lengthen their
horizons.
Yeah, and gratification and the way that it works.
Well, this is life as a whole, isn't it? And it takes us back again to the eating thing, right? It's that instant gratification that people are chasing. Chasing more than 25% gains in a year is going to be problematic. We had a long conversation on the podcast yesterday and before the podcast as well. It was probably more heated off camera than it was on camera. And in the art of investing, we have had a really incredible 2-month performance. Now, we're getting close to our target for the whole year. Is the whole market demonstrating some kind of greed at the moment?
Absolutely.
And, we know what happens next, don't we?
We do. And you came on the show and said it was going to drop by the amount that you said it was going to drop, and it happened within 3 days of that show. And we had to rush to get the episode out because it was so timely, and we've seen the indicators. They're all showing it's extremely overvalued at the moment. And I think it's time to perhaps protect yourself a little bit. If that was me, I'm not saying that's not financial advice, of course, but I think it's grown to like insane levels again. You know, all the indicators are showing that. And so I think it's a little bit of a time to just perhaps evaluate what's going on and if you've got any sort of wide open positions.
I always love, especially on Fridays, I love when people take their balance at the moment, right, what the account is sitting at, and then, right, now take that number by 20%. How does it feel to be looking at that number 20% lower than your peak?
Yeah.
Are you happy with that? If that doesn't really disappoint you, then you can still take risk. But if it does disappoint you, time to rein it in.
A good way at the moment is a lot of these accounts are giving you interest on uninvested cash. So ask yourself,
IG, 4%.
Exactly. Yeah. So like ask yourself if you're happy with it, almost like the inverse of that. Well, if you went in some of it in cash and you made 4% out of it, or you lost 20%. Yes, you know, you're not getting your 10, 15, 20% gains from that point on.
Yeah.
But your protection at that point when you can see that the indicators are showing. So I think the introduction of the uninvested cash element in a lot of these accounts is like enormous, because it just gives you that like a little bit of safety. Oh, I don't need to then pull that out, put it in a cash ISA just to get something off it. You can just leave it in the account ready to go. And I like having a little war chest. I always have 3 to 5% in cash, and I'm probably pushing a little bit higher than that now.
Because life can be expensive, can't it?
For sure.
And if only there was an app which helped life be a little less expensive.
I like what you did there. Yeah, exactly.
Now, what is this new what do they call it? String to your bow.
String to the bow, yeah.
Yeah, tell us about, maybe we can get it up on screen as well, Gains app.
Thank you. Yeah, so we have spent a lot of time making content in the space. We deal with people at mass scale. We do about 130 million views a month at the moment. It's nuts. And so with that comes a lot of data and a lot of questions, and we are seeing what people are struggling with most. And yes, we know more people should be investing, but the day-to-day management of their money is a massive, massive problem. Yeah. And so we've created a budgeting and cashback app, which is powered with AI and open banking. So essentially we can personalize someone's spending insights. So you can essentially download the app. It will be out later in November.
Right.
And you connect your banks. You get a 360 view of your money, your savings accounts, your credit cards, your investment accounts, exactly what's going on. But then the AI can analyze those and give you insights and things to do. But it can also then save you money on the front end. So when you're everyday shopping, if Rich goes to Tesco, I go to Sainsbury's, it's going to know that. And it's going to give you instant cash back off.
Aldi for me.
Aldi for you. Yeah, I'm more Waitrose. I do apologize. So it's really cool because it's the day-to-day spending of your money. At the moment, what you would have to do is you'd open your banking app, your budgeting app, you'd have a spreadsheet or a bit of paper, and you're writing out how much things. Here you can just come on and go, how much have I spent on takeaways last week? You can actually talk to it as well.
Right.
And it's going to go, bing, you spent 74 quid in these retailers. And so it's going to really have that sort of instantaneous view around your money.
Yeah.
Getting you the answers that you want to kind of help you plan ahead for those bigger things, those moments, or those investments that you want to make as well.
So out in November, but you can join the waitlist at the moment.
You can indeed, and you can get every single person that signs up to the waitlist gets entered in to win their shopping paid for an entire year.
For a year?
For an entire year.
I'm sorry, I'm not Aldi. I take it back.
You can go wherever you want. You can choose it. So we'll pay for your shopping for an entire year. Yeah. So you'll be one lucky person.
That's unbelievable, right? Everybody on the waitlist, go on. You got to share it, right? If one of our viewers wins it, I want some involvement in that.
Free shopping.
Have there been any funny moments on? Go on, take us through your...
It's Michael.
Is it really?
It is Michael. He said something that just got me at the core, because it has its funny side, but what he said was quite powerful. And he was saying, you should shop local and stop giving money to big corporations.
Yeah, he hates
We were talking about Starbucks.
Yes. And
how his literal hatred for it. And then he dropped the bomb that the coffee tastes like burnt cigarettes. And I was like, it was one of those moments in the studio that I couldn't stop laughing. We had to stop recording. Because the way he says it is so dry. But unfortunately, because it's a money podcast, it's not like a comedy show. I think a big thing is to tune into Rich's episode and watch his prediction.
Well, we got another one. We're just,
The timing is perfect again because we seem to be at almost exactly the same point. So it's be interesting to run through this time.
Actually, I'll have to watch it back before Monday to make sure I just don't say the same thing again because it feels like it. But let's take a look at Starbucks because I've had a couple of very smart people, including Julian Wheeler. Starbucks is one of his favorite shorts. And that's the second really smart person that I've heard. So, not just Michael talking about how bad the coffee is. This thing is showing really poor price action compared with what the S&P is doing. And I just want to keep that in your mind because Julian thinks it's going to 60. I could definitely see it at 70, which is a good sort of 12% lower. Starbucks, Julian's point is that it's going to have to shrink to start growing earnings again. He cannot grow earnings off the current base at the moment. So,
yeah, well, they're closing a lot of stores and they got rid of a lot of staff, especially in the UK. And it doesn't seem to be getting much better across the world as well. So it's a very interesting one to be looking at in terms of that at the moment for me as well.
Yeah. So, anything else any other stocks or companies or indices that you've got your eyes on at the moment?
So I'm not adding at the moment. I'm being very careful. I've kind of got my positions. I have a lot in fintech in the US. I have the likes of SoFi and dLocal and Upstart as well. I love those types of businesses.
Take us through some of those. Sorry, I don't know SoFi.
SoFi are almost like the British Monzo. The American Monzo.
Mm-hmm.
They have a wide berth of current accounts, but they also have kind of like an embedded IG into them as well. They do crypto loans. They started out as a student loans company,
okay.
And then have developed a sort of full financial suite. The CEO, Anthony Noto, I find very impressive. And it's that real challenger bank. And I think the US at the time was kind of ripe for that, as we've seen with the rise of Revolut and things like that as well across the world.
Yeah.
I think the US was really ripe at the time. And I've had it for quite some time now. And every time it drops back down, it's had an incredible run.
It really has.
And it's one of my favorite holdings.
For anybody watching, that was $10 back in the April sell-off, and now it's 28. So 280% return. Nicely done, sir.
Yeah, it's been great, and we will continue to add anything above sort of 15 for us, because I think that at below 15, if it drops anywhere back down at those levels, like we will be very hungry.
Yeah,
because it's growing.
And we do have to touch on that in that. I'm 100% cash at the moment. Anybody, now that is really making a strong statement to, I think we get a correction. Don't know if we get a crash, but we get a correction.
You're 100%.
100% cash as of last week.
As of last week?
Yeah. SIP, ISA, pension.
Oh, you went big.
100%.
Oh, interesting.
Yeah.
Okay.
So
We've been
I should have kept that for Monday.
By the day. Yeah, no, fair enough. I'm going to have to ask you about now.
Well, yeah, and I'm not pretending I can call the top, so it might go on for weeks yet. In 2017, going into 2018, I was a month early. But then we got a 10% correction in a day, right? And that's what it feels, that I feel like we're building up towards that.
I have a question for you, if you don't mind. What do you think the catalyst will be?
He can't help it. The interviewer.
100%. It's just, I was discussing this yesterday with a couple of people and they had different answers. And I found I'd love to know yours. So like, what do you think is going to be the trigger this time? Because the last one was Trump.
Yeah, and this came up in our own podcast yesterday in The Art of Investing. We were saying there's no way you can ever guess what the catalyst will be, but you can certainly watch out for the canary in the gold mine. And that's what we're going with at the moment. It's obviously gold has, in my opinion, has now become a risk asset.
Yeah.
The First Brands credit implosion, right, is a mini SVB moment, and the market has not blinked, right? You've had a huge business which has cost private equity and the banks, in the hundreds of millions. So I do think that is that the start of something? Maybe in 3 months' time we see more private equity deals that have gone really bad, and they actually have to write the real figures down. So leverage, private equity are certainly two potentials.
Interesting.
Samuel King, thank you very much for coming in.
Thanks, Rich.
And it's been really interesting. Money Gains on the YouTube channel. It's easy to find, isn't it?
Yeah, very easy, yeah.
Sammy, we'll see you Monday.
See you soon.
And we are back on what is still a Kane founding week for all kinds of assets. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan. Mr. Mike Butler back with us, our returning champion in Chicago. Of course, this is overtime, and we're going to try to make sense of what these markets are doing after hours while keeping an eye out for these Tesla earnings. They should be showing up any moment now, theoretically. Obviously, Netflix didn't do us justice yesterday. The markets didn't like them, but it doesn't seem like today's indigestion in the markets had anything to do with that. Gentlemen, what do you make of this? We kind of gave up momentum today after barnstorming at the start of this week.
Yeah, it was kind of crazy. I mean, we had I was on the show today when we had that flash 30-point sell-off that has since been gobbled up. But we're seeing some resistance here. I thought it was just going to be a rocket ship like up here, but we didn't get that. We're getting another big range today of uncertainty. However, I will say volatility futures did not move at all today. We are still in contango, and that's, I think, even more interesting than this intraday move. Like this move today, I thought would have created more of a flat vol curve and more of a spike in vol futures. You did get a little boost in the VIX itself, but even that got crushed to end the day. So it may have just been an algorithmic digestion of something that was said about two countries working together or not working together. And then maybe it was walked back. I don't know. What do you guys think about it?
I mean,
Dylan,
at this point, I'm going to go back to my sort of default position. Forgive me. Which is that all thought is bad thought.
That's fair.
Thought, the enemy of progress.
Well, I don't know about progress, but it's the enemy of profit for sure. So I've been through this more than once, as we all have, and I'm actually very grateful that our celebrity guest host for the day is Mike Butler, who is a strong subscriber to the buying of the dip, as it were. And I would say anytime this thing gets squirrely, obviously a little squirrely today. But again, like I fooled myself with some thinking a few days ago because we had that big sell-off. You can see the chart. All the things. I didn't care about the sell-off. We fought our way back. But then last Thursday, whatever, 6 days ago, we found ourselves in another sell-off, which I misinterpreted as a result of my thinking as, oh, this is a negative sign, blah, 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 blah. But actually, it's all an opportunity to buy the dip. I mean, there's nothing more reliable than buying assets when they are on sell-off cycles. So if you have a sell-off cycle today, it has to be an opportunity to acquire assets. It's the only reason, it's the only reliable thing in this entire market is the tendency or the reliability of buying these sell-offs, including the one today.
In fairness, the sell-off today does ultimately find support where previously it had resistance. So that range that got carved out last week as the markets were digesting the holy moly sell-off on October 10th, that carved out a little range. At the start of this week, we stormed through the top of that range, of course, ran directly into the highs and stopped cold right there. Couldn't make it over. And as we pull back today, we pull back to the top of that range, but pointedly, we don't get back into it. We don't break back down. So whatever upside breakout there was on Monday seems to be holding for now. Obviously, Tesla pending. In my mind, when you start to unpick what the markets did last week and this week in the wake of that big sell-off, I don't think we're prepared. I'm certainly not prepared to declare that that big sell-off wasn't the mark of a major top. Obviously, that major top was going into a week with lots of earnings. And last week, we tested this theory. Last week, the markets attempted to rally and attempted to rally again and attempted to rally again day after day, and they couldn't stick it. This week, obviously, they started much stronger, ostensibly because we have actual tech earnings with significant market cap this week. We didn't have that last week. We just had the banks. So you go into this week and the markets even out, essentially. They erase the October 10th sell-off. They basically reset. S&P resets, NASDAQ resets. They don't manage to do anything more. And then the day that the earnings actually start, which is yesterday, because Netflix is kind of the first of the two that matter, the two big kind of market cap behemoths this week. Before Netflix, everything stalls. Netflix overnight disappoints. We get a pullback. Now we get Tesla. In my mind, we're still looking to figure out whether October 10th was the real deal. And we don't know.
But don't you think we do know? I mean, we've been at this for a decade.
I don't think we know, because I think there is the obviously correct assumption that we are in the midst of a technological transformation akin to telecoms, akin to railroads, akin to the radio, transformational things. Our friend Andrew Ross Sorkin just published a book called 1929 about what led into that debacle. And he was just talking about it on Bill Maher's show last week and sort of very nicely illustrated. We went into that with this level of exuberance. Only that time it was the radio and RCA. And the RCA was the NVIDIA of that day in terms of market cap, in terms of level of speculative fervor. That doesn't mean that we're going to collapse here. Now, who knows? But it's not like we haven't seen this movie before, and it's not like that collapse canceled radio. It didn't. The collapse of the .com episode didn't cancel the internet. So when we talk about, okay, well, there's a supernova afoot, obviously there is. The question is, at what point do you get the kind of initial washout before the real thing has a longer arc? Where does the kind of hype cycle initially that always accompanies these things in the beginning, where does it hit a wall?
But don't you think that that's like the exception that proves the rule? In other words, that like it's easy to point to the situation that says that this horrible thing is going to happen.
Right.
But 99% of the time, the horrible thing is not what happens. And worrying about the horrible thing that's going to happen is a way to not make money.
I mean, if you're talking about 99% of the time on a given day on the way up in a bubble, the horrible thing isn't what happens, then yes. But if you're talking about 100% of the time, these kinds of things end in a debacle, that's likewise the case. And we can go back to South Sea warrants or railroads or whatever great technological breakthrough you can think of post the Renaissance, which is about as old as we have.
But the fact that you can refer to these situations indicates how exceptional they are. The fact that there's a book that's a bestseller, that's super popular, that everybody's talking about 1929, it's not an indication that that's going to happen. It's an indication that it's so unusual and so extraordinary when it does happen that it's worthy of a book 100 years later.
What it is a distillation, and we've seen similar ones from Dalio, from Howard Marks, from you name it, people who study these things, is that when these types of frothy situations occur around the advent of revolutionary technological change that is transformative for the economy, this happens every time. So the question isn't, is this exceptional? It's not exceptional. It's not exceptional at all. We don't get transformational technological revolution on a regular basis. That's the part that's not exceptional. But every time we get one of them, there's this kind of sequencing to it. And so the question here, in my mind, isn't is it going to happen again? Of course it's going to happen again. The question is obviously from the perspective of timing. And to your point, if you're an investor, then of course this is exceptional in the grand arc of equities generally being biased higher over a period of decades.
But if you're a Tasty Trade customer or a Tasty Live viewer,
yes.
Are you going to spend your life being Mike Butler and buying the dips when they happen because you make money 99% of the time? Or are you going to spend your life trying to set up for the one time in 100 years that the whole thing falls apart?
I think you set yourself up for both, and the watching of price action becomes a critical exercise in that sense. Because, again, it's not that this happens once in 100 years. It's that this happens every time that there is one of these transformational technological booms. I mean, the last time it happened was 25 years ago. So when you look at this and you say, okay, all the ingredients are there, but the price action doesn't tell me the holy moly is upon us, well, then you do the Mike Butler. But if the price action tells you, hold on a minute, something is different, you back up. And if you're a glutton for punishment like me, then what you do, despite all of your best risk management efforts, is when you see the thing get weak-kneed, take a stab at it, take a little loss, and that's going to be inherent because the bubble is going to be the bubble until it's not the bubble. So there's going to be a lot of this that goes wrong. So as long as you manage the risk and lose a little. The hope is when the inevitable is upon you, you make back multiples of the little losses that you made along the way.
Yeah, I think there's something to be said about both angles, but this is where like the tastylive viewer comes into play in the sense of like making more intelligent decisions. Like even if let's say you want to buy the dip all the time, I'm always going to revert back to the vol futures. Like if I see a 60-point sell-off in the market and I see no movement in vol futures and contango in vol futures, I am way more willing to buy the dip in that environment than if I see a Friday movement where you've got a 150-point sell-off paired with a 3% move in the front month future, which put it 2 points ahead of the next one. The second you go into backwardation, all bets are off. And I think that is the most important thing to learn from a vol curve standpoint, because it speaks to both of your points of, I don't want to think, I just want to buy every dip. That applies to me in the contango futures market where we have low volatility. But when we go into backwardation, if you look at the past 10 years of big sell-offs, 20% or 30% of the equity markets, every single one of them had backwardation in the vol futures. So if you just pair that with, if we are in backwardation, I take the foot off the gas. But if we're in contango and I see a sell-off, I'm just going to buy that dip until proven otherwise. But at the same time, you can't go crazy with it because these vol futures will change on a reflection of something that's already happened. So we were in contango on at the beginning of the week where we sold off 200 points. But on Friday, we went into backwardation after a 200-point sell-off. So you have to be mindful of that as well. But I think buying the dips, it still makes sense to do so, especially as those moves grow and grow to the downside. Like the tariff stuff is a great example. At a certain point, and that speaks, I think, to how markets are now versus how they were before. Now you have 10 companies that basically control the market. Before, it was similar, but not as extreme. Like the extreme valuation of these companies that rule the market, at a certain point, when people see and when retail traders and institutional traders see that these companies that are not going anywhere are down 30, 40, 50%, at some point, somebody's going to step in and that creates the reversal. And I don't think we will be, I don't foresee a situation where we have markets that don't have those velocity moves to the upside and downside, even when we have super turbulent times. But even in like the worst case,
my whole concern is that there's 1,000 reasons always for why the market can crash or can decline substantially or whatever it is. But I'm just going to come back, not like a broken record, but that so much of the time it's a situation where that doesn't happen. And so you get yourself into a situation where all the thinking tells you that this is not a good idea, that this is not advisable, that you don't want to do this. But at the same time, 99.9% of the time, the correct decision is not to get lost in that analysis, but rather to take advantage of the fear and the anxiety, and then ultimately buy the assets.
Which is, I think, exactly right. And why you have to look at the price action, to Mike's point, and not just the sort of baseline price action, but the architecture of the price action. What's vol doing? What's price action doing relative to vol? Sort of, where are you? Because you can't, I think, blindly buy the dip in this environment. But also, that's been the thing that's worked, and it will continue to be the thing that works until it doesn't. And there is no telling when that is. Macro, my discipline du jour, is notoriously terrible at timing. And so if you don't anchor yourself in the price action and you just spend all your time thinking about all the bad things, Dylan, to your point, that could happen, you'll miss everything all of the time. You have to let the price action be your lens.
I mean, what price action exactly are you talking about? Because the only price action that I see is every time you get a decline in prices, the beneficial trader is the one who buys the decline.
Take a look at the S&P 500. It hasn't made a new high since October 10th.
And
since
yet, anytime there's been a pullback, it has ultimately returned to an ascending.
It got rejected from it again today.
But still, are you better off to get short the S&P, or are you better off to buy the dip?
I think if you're a trader, then you are much better off short the S&P as a new allocation of capital, because the risk reward is orders of magnitude better. Now again, as a trader, laying out fresh money, not a long position you've been sitting on, not anything where you're fighting other exposure that you might have. If you're looking at this with fresh eyes and you're saying, okay, right here in the S&P, am I closer to a top? Do I have more room to go up or more room to go down? I think very clearly, until you break the October 9th, 10th highs, you have very little room to go up because they're still holding you in. Now, if you break those levels, it's a different story. The whole risk-reward math is reset. But as long as you're sitting under those highs, you're much better off short. That's much better odds. Your risk-reward is many times over better. Because if you're wrong a little. And if you're right, you're very right.
And
I just feel like, go ahead, Mike. Sorry.
By short, you mean like spreads? Like, are you saying like
risk
shorting?
Carefully, small risk-defined verticals that, for example, I'm doing in SPY and the Qs because I don't even want to go to MNQ. Even that's too big. Because you're fighting a market that's not going that way. So what you're doing is you're taking opportunistic pot shots with the idea that anytime, you have no idea when this thing is going to turn, and chances are it'll rally in your face until it doesn't. And so what you're doing is when this thing looks weak-kneed and the risk-reward looks good, you take a little nibble. And you see. And if it goes, it goes. And if it doesn't go, then you lose a little. And you can do that 10, 20 times. But if the turn becomes what it becomes, and as it inevitably does in these scenarios every single time that we have records of, anyway, then all those 10, 20 micro losses get absolutely swamped in what is an avalanche of selling. And then you buy that dip.
It all comes back to buying the dip.
But that dip is a 20% dip, not a 2% dip.
Yeah. No, I hear you. But yeah, I think when markets that are at highs, when volatility is low, in hindsight, that was the perfect situation to try and take advantage of something like this that we did not yet know was going to happen. But now we have a little bit more elevated IV, which is going to increase the cost of something like this a little bit more. But yeah, I mean, a 20-point wide diagonal spread where you're reducing the cost basis by 30% on the long option you're buying with the sale of a short option that has half the amount of time is a nice hedge to the downside. Even if you're wrong, you can move this 20-point wide that you paid $8 for. You can move this into a 10-point wide and reduce basis even further. And now if you have bigger long-term upside plays, this doesn't even matter because you've offset it. So
no.
Yeah, I think
that's exactly it. You're opportunistically saying, okay, yeah, vol's a little bit higher, right? There's no free lunch in markets, but you do have a range that extra vol has now carved out for you in the S&P, in the NASDAQ, where you have a near-term bottom where the October 10th thing landed, and you have a top. And so you have risk-reward guardrails where you say, okay, if it goes above this high, I'm wrong. If it goes below this low, it's a bigger sell-off than just another point of consolidation. And so if you're near the top of that range now, you go, okay, yes, I have to pay up a little bit more for vol, but I have very clear risk-reward parameters. So in waiting for this range to set up and in waiting for vol to go up, I've basically spent a little bit of money inherently to have very clearly defined barriers to say, let's take a stab at this thing while the risk reward of 2 to 1 better could be had, and let's see. And if it fails, it fails. And the next time you attempt that isn't when it makes a higher high, it's when it gets cold feet again. And so you try again.
Yeah, I think it's fair.
I just don't see how you can advise. I just don't see how you can advise. I mean, how do I say this? I just do not see how you can advise anything other than buying the dip. Yes, there is a chance at some point that something will happen that is horrifying and a catastrophe of sorts. But at the end of the day, 99 times out of 100, what you're dealing with is an opportunity to buy assets at lower prices in advance of a rally. It's just what it is. I mean,
I think exactly why you have to look at the price action. You can't just be selling into rallies because you think that eventually they're going to fail. That's a recipe for disaster.
What specific price action are you looking for, and what does it communicate?
On October 10th, we set a high with a massive sell-off. We have not been able to overcome that high. Every time we attempt to come back from that high since that sell-off, we fail over and over again. So when you fail again at the same high, you go, okay, maybe this really is a top. Let's take a stab and let's see. And if it takes out that high, then it's not the top and you lost a little. But if it is that high and the thing turns into an elevator down, you have made many times over what you're going to lose, which is why you use verticals, risk defined, why you use smaller instruments like the ETFs, in my mind, but why you would also run for the hills were you to break that high.
Yeah, fair points. But yeah, I think, again, it's hard to time when the collapse will happen, but even when it does, and this is why, like, if you're exclusively investing in SPY or the Qs, for example, even when it does, your worst case scenario is 30-40% down in a year. And to Dylan's point, if you can absorb that, you now have a basket of opportunities to do whatever you want to the upside, because
long as you didn't tie up all your capital in holding forever and you were nimble as a trader. Again, if you're an investor, and I do that also, just not with the same brain and with the same strategy, but if you're an investor longer term, then all of these washouts are just reasons for you to keep some powder dry so you can buy more without getting out of your long-term holdings and just accumulate forever, decades on end. But that's not what we're doing here. We're opportunistically trading markets. And in a 45 DTE world, when you've had the kind of run we've had, and when the history of these runs is what it is, they end in tears every single time. You just don't know when. The question is, Could it be in the next 45 DTE cycle that it ends in tears? Yes. And you just have to know that and be ready for it. And if the opportunity presents itself to say, well, maybe the market, the price action is tipping its hand that it might be here, take a little nibble. See what happens.
How about Tesla? Down 8.
So interesting reaction here. Shall we go over the results here?
Sure.
So Tesla, third quarter adjusted EPS of $0.50 or 50 cents. That's a miss. Expectation was 54 cents. And the GAAP EPS is 39 cents. That's a miss versus 62 cents expected. Revenue of 28.1 billion. That's a little bit of a beat. 26.4 was expected. Operating income of 1.62, a little bit below expectations of 1.65. Gross margins of 18%, better than 17.2% expected. Free cash flow is the real standout. 3.99, almost 4 billion versus 1.25 expected. So really a huge beat on free cash flow, but soggy on the earnings. Obviously, the real question is what happens here going forward, because that EV credit is expiring, and that's going to change this landscape completely. So the guidance will be really important here.
Yeah, it's well within the expected move. Only down 7 points now, rallying off the lows. But yeah, I feel like we've seen this a few times with Tesla, where we have this implied move that's significantly greater than what we actually get. It is very interesting to see.
Yeah.
But I mean, don't you think, again, that's an opportunity? Tesla, anything is an opportunity to buy Tesla. I mean, there's nothing more significant than what we've been talking about for the last, half hour, then it's an opportunity to buy Tesla. I mean, whatever it is, any decline is a decline that is an opportunity. I mean, there's nothing more, there's no better example.
I mean, this is really the key, right? Like when we say every decline is an opportunity, I think we have to qualify the size of the decline, because clearly not every decline is an opportunity. We can see it in the Tesla chart. There are days where you get a sell-off and then the next day you get more sell-off. So if you bought the very first down day, there's plenty of instances here where you've lost money. So in a trading world. So, and in fact, if you look at where Tesla is at the moment, I mean, we can see it, I think, clearly here on the chart that we have up on the screen. Tesla is only back to where it was essentially mid-December of last year. It clearly had a massive sell-off from mid-December all the way through mid-March of this year. If you blindly bought every one of those dips, you'd be down money most of the time. And at this point, if you just held, having bought that first dip near the top, you'd be barely break even now. So obviously, not every dip is a buy. Clearly. The question is, how much of a dip is a buy? Because when we say, we'll buy every dip, buy every 1 day dip, every 1 week dip, every 1 quarter dip, none of that is consistent, especially for Tesla, which is just barely back to square after its early in the year sell-off, in the sort of grand scheme of things. So again, it comes down to price action, in my mind, anyway.
Well, I think it comes down to price action. It comes down to liquidity. It comes down to company size. Like, when we say buy every dip, I'm agreeing with 20%, 30% discounts on Mag 7 stocks or tech stocks that are not going away, or even airlines. Like when we see a sector get bailed out, that's a green light for me if it ever gets back down to those lows. Like it's a scenario where if we are not letting a company fail, I think that's an even better opportunity to invest in a company. But that's, I guess, maybe another discussion. But to Dylan's point, if you are SPY, QQQ only, it makes a lot more sense to buy more dips, because these are not companies that are going to zero. These are charts that, if you look at these charts, even in the worst case scenario, these get gobbled up quickly. Like this is obviously a longer time frame, but this has been insane. We've seen big velocity to the downside and upside. Here's COVID right here, and then we just rocket shipped. But that's again because these companies benefited greatly from everyone being locked inside of their apartments and homes. But yeah, these products, the Qs and SPY, I think I'm more inclined to buy more dips. Companies
of course, they're much more liquid. Their dips are likely to be shallower, almost by definition.
Yeah, totally. Products like Tesla specifically, I want to see a bigger dip. Like I want to see 10%, 20% or more before I'm like, yeah, definitely getting into this. But like Nvidia, I think I'm more inclined to buy more dips on smaller moves, because this is kind of rating the companies that I personally believe are not going anywhere and will continue to go to the upside. But naturally, you have more volatility with Tesla. So higher vol products that give you realized moves, I think it's easier to be more patient because you've seen bigger sell-offs, bigger moves, and bigger opportunities in the past, where Nvidia, I guess you could say the same in this short period of time. But if you think this thing is going to 400 eventually, and that's your thesis, then I think you need to acquire for that idea, ultimately, in whatever way you want to, whether it's short put spreads, long stock, long call leap options, and that's another layer. Like if we see another tariff situation where Nvidia gets cut from 180 down to 90, I'm going out to the 2028 leaps and I'm just going to buy the 200 strike leaps.
Which is a whole, that's a totally, yes. Yeah. That's no longer a 45 DTE conversation. It's no longer the kind of opportunistic thing you're talking about. Now you're saying, okay, forget investing into cash equities and big funds over a 20, 30-year time horizon. Forget also the kind of jumpier, more opportunistic month in, month out, month and a half in, month and a half out type of thing that we're talking about here. Let's talk medium term, somewhere in between that. I'm doing this with EWZ, which is one of my big long equity positions, where you had a big breakout. If you look at a weekly chart, you can really see it. You had a long structural decline. Take a look at a 1 week. Yeah, there we go. So you get a long structural decline, and then you broke that decline. I mean, that to me is okay. So buy a bunch of leaps and wait, and when there's a dip, buy more, because you're not going to figure out what's going on in Brazil to this level of granularity day in, day out, but obviously something has changed. The big picture is different. Take your shot. Which, I think I've been holding them now. Let's see. I have been holding these EWZ calls for 170 days. And they don't expire until mid-January, and I'll probably roll them for another year.
Yeah, I like it. There's layers to these
I mean,
things. There's
yeah,
layers.
I mean, it's a different type of an idea.
Speaking of layers, there are gold shavings flying from the rooftops.
I love
Dylan,
it.
I know you were short gold, long dollar. Are you flourishing in this move, or what are you doing here?
I mean, what I'm doing is kicking myself because I really was popped up on being more short gold than I am. Long dollar, fine. But again, if you saw the conversation with Jamal, I was all verbally like, oh, short gold, blah, blah, blah. But I honestly didn't do it beyond the sort of existing sort of Radigan trade, which is marginal, and kicking myself. And so, so I got a big mouth and a small bank account as a result. So good luck to you with that, but at least I have the sort of moral gratification of being right.
There's always that.
That doesn't pay the rent. And so the real question is, what do you do with gold now that it's broken?
So I have a whole spiel on this that I'm going to do on macro money right after this, but I'll give you guys the sneak peek. What this sell-off did in gold was end a 9-week rally. Consecutive 9 weeks of gains. The last time we had a sell-off of this size, over 5% in a day, we also ended a 9-week rally. And in fact, that was the last time we had a 9-week rally. And that was early August 2020. Going into that month, Jackson Hole, where the markets, and this is just context, where the markets thought, the Fed is going to do something on top of open-ended QE and rates to zero because COVID, yada, yada, yada. And then as you started to get into August and into mid-August, and it started to be more apparent that no, the Fed is not going to do more, that they're not going to do negative rates, that they're not going to do yield curve control or some other form of extravagant, unorthodox easing, that gold topped. And so then as now, you had 9 consecutive weeks. Then as now, you get an over 5% daily sell-off to put the top on those 9 weeks. What happened last time, and again, this is a sample space of 1, so this is exactly, Dylan, the kind of situation that you were talking about where sometimes, rarely, a thing occurs. So 5 years ago, this thing occurred that was almost identical to this in terms of its setup. And in fact, the last time it set up this way was then. You got a decline from that high then of 19.2%, which amounted to a $398 decline at the prices that were there then. If you look at it now, if you had the same dollar price decline, $398, that's a 9% decline in this market. You essentially already ran that move. But if it was a 19.2% decline like it was last time, then you'd end up at somewhere around 3,400 for gold. That'd be a decline of $841, give or take. We're maybe halfway there. But we have more to go. What's interesting is that if that's the model, then you're back to exactly those swing highs at around 3,400. That would be the natural support, or at least point of friction on this chart. So in my mind, who knows which of these scenarios it is? Are we done or are we not done? But I was sharing my annoyance yesterday. I had no idea, Mike, that we had 1 ounce gold futures. Because when I saw it roll over overnight, I was like, oh, damn. I don't want MGC or GC as a futures short outright overnight. If only there were something smaller. No, I have to wait to do this through GLD when the cash equity open occurs. had I known, and this is my own ignorance, that there was a 1 ounce gold future, I would have sold it overnight and participated to a much greater extent. Instead, I'm selling calls, a call vertical in GLD. And it's making a little bit of money, but not much, because obviously the bulk of the move happened before I got that off.
Yeah, this is a nice small product. I have not personally traded this. I have some short positions in GLD that one of them I put on many moons ago, 345, 335, which somehow is actually still possible. But this 370 calendar is what I put on. Speaking to, like, if you're going to short something, stay really small, defined risk. Like, if we get down to 370, this actually was doing a little bit better this morning when we were closer to it. But this is a $200 trade that I'll be able to get $100 out of it if we go to 370 in the next week or two, or tomorrow. But yeah, strong return on capital for very little risk. And this diagonal is certainly more return on capital for a larger amount of risk. But yeah, when these products are moving, especially GLD or gold futures or whatever, we've seen the realized move far exceed implied volatility. And what's funny to me is now, with gold selling off and showing some resistance from the moonshot it took, you're seeing volatility collapse a little bit, which still 27% implied volatility for a product like gold that is whipping around every single day. These do not match. So I'm not selling premium undefined risk in here. You can still sell premium defined risk to create more of a range to be profitable. But these are the environments where I like to be debit directional when I see a 20% IV product moving around like a 70% IV product.
Yeah.
I was going to say something else, but I forgot. The 1 ounce product. Have you traded it yet?
No, because I realized that it was there belatedly and frankly by accident. I was typing in the quote for the 10-year future, and I sort of mistyped and stumbled out. And I'm like, wait a minute, what is this? I didn't know that it was there. If we get a meaningful break, I might use it to add to this exposure, because I mean, a tenth of the margin that you would pay up for MGC, and yeah, it's probably not going to be that liquid, but okay, do market orders. It's small enough.
Yeah,
you're going to get probably a little bit of slippage on the way in. All right. The same way that you would do with M6E, M6B, M6C, all the kind of micro currency futures. You can, there's no options on them, but the margin requirements are so small. I've just been putting them on, just directly buying the futures, selling the futures. With these 1 ounce gold futures, you can do the same thing. It's comparably small margin outlay. So I'm probably just going to go straight. If I wanted to add to this gold position, I'm probably not going to be adding at this point through more GLD. I am probably going to be adding through those futures directly, just buying and selling them.
Yeah. That's how I prefer to do it too with some of these products, like not necessarily MGC, but MCL.
Yeah.
That one is, I've been trading this for many years, just straight up long and short, not mostly long contracts or short sometimes, but usually long if we dip down here. I closed this one today for like $160, but I prefer to be
mine too.
I prefer to be static long when you have a two-sided market like this. Gold is tougher because we have not seen a two-sided market until the last couple of days. But if you look at any annual history of crude oil, you see opportunities to get in on the downside, opportunities to short on the upside, and there is plenty of two-sided action. And I love these as a vehicle for trading because as long as you're small enough to where you can absorb literally a move to zero or doubling it, it's great. It's just kind of like a set it and forget it. Wait for something to happen that's an extreme and then take the other side. It's been a nice trade for sure.
Well, yeah, and when it's small enough that you can just use market orders on the way in and out, and you don't really care terribly about a little bit of fuzziness, you don't need to force limit orders on it because it's small enough that's okay. The flexibility this affords you is amazing because you can manage your exposure overnight. If you see, for example, like this case was a perfect use case. Gold was starting to get weak kneed before the U.S. cash equity open. It started to come off overnight. The futures are the perfect vehicle to go, uh-oh, here we go, and take a shot. And the 1 ounce futures let you do that in a size that's reasonable. Unless, of course, you have deep pockets, in which case, Godspeed. But I'm trying to keep my size contained as a risk management thing.
Fair enough. How about the moves in bonds and rates today, or really this week? It's been kind of wild.
I've enjoyed them. I'm long a TLT vertical that I've been adding into. I've had it for a while. I don't think there's any reason to get off the boat. It's part of the reason why I've been bashing the desk, screaming that this gold move on the way up or on the way down is obviously not any kind of debasement narrative, because since mid-September, bonds and the dollar have been going up with gold. So obviously it's not acting as any kind of foil. Obviously this is not some sort of debasement of U.S. Dollar-based assets. If you're arguing that, stop it. The price action is telling you that that's not what's going on. So I'm still long. It seems to still be working.
I like it. Yeah, it's been a week for these markets. That is for sure.
I did take off my crude oil short today. That bounce today spooked me out of it. So I made my money. Thank you very much. This is a hat tip to Mr. Westwater, who said, oh, we've probably hit a new level of support there at the April lows, and we're probably going to carve out a new range. Certainly made a move to do that today. So once it started to come off that support, I opened the markets this morning about 10 Eastern, 9 Central, as I was about to take the kids to school, and said, okay, it's that time.
Mm-hmm.
I've overstayed here. Time to go.
I love that. They're like, what are you doing, Dad? Just closing my crude shorts.
Yeah, don't worry. Just eat your Cheerios. I got to get out of these crude shorts.
Dylan, you've got a ton of the big tech names reporting earnings in the next week or two. What are you most excited about if there's one or two that you have handpicked to not miss?
Amazon. Amazon is my favorite name in the Mag 7. I've said this over and over again. I mean, I like how Apple's behaving on the back of the iPhone 17. I like Google on sell-offs as a result of sort of ChatGPT browser jitters. But I think of all the names, Amazon is the most interesting name, full stop, just because it has not really performed the way that some of the other Mag 7 have. I think they've got I think all of them have rabbits in the hat. And I think that Amazon is the one that's due to pull a rabbit out. I don't know that that's earnings related specifically, but I do think of the Mag 7 that Amazon is the most interesting name to load into a little bit on the expectation of a big bump. And I think Google is the most interesting in terms of any sell-offs that happen as a result of ChatGPT jitters. And I think Apple is the most interesting in terms of its overall behavior, just in terms of a trading perspective.
Mm-hmm. Mm-hmm.
Yeah, I would agree. I think I think there's opportunities in the market now, but when we're at all-time highs and the VIX is at 10 or 12, like wherever it is, you may ask yourself, how can this thing keep going? And then you look at names like Amazon and you see, oh, this thing is 5% or 6% off of its highs. There could be a rotation into this and out of others, and that's how that works. So, yeah, I think calling out the tech stocks that are not yet at highs while these others are, I think is a strong conviction point for those looking to get long into a macro move like this with earnings on the horizon for sure.
Yeah. Yeah. I mean, this is now going to be very interesting because, of course, we are basically done with the big cap earnings, at least in the kind of Mag 7 tech adjacent holy moly space for the rest of this week. And now we've got these CPI numbers on Friday and the PMI numbers to come with them. Yes, we're going to get earnings, but I mean, just look at the bank earnings last week. It's not like those were insignificant names and the markets could not make hay of any of it, this way or that. It was a hodgepodge. Some missed, some did well. Which ones rose or fell had nothing to do with the earnings results. Some rallied on bad results, some fell on good results. There's no rhyme or reason that was easily discernible until you got basically to Friday and you said, oh, okay, on down days, everything is down. Even when they beat on up days, it's kind of a wash. So for the rest of this week, I'm not even sure the earnings calendar matters. I think we're going to have to get some big tech names again next week to even think about this again.
Yeah, you got Amazon, Apple, Google next week on the 29th and 30th. You've got Microsoft on the 29th as well. And Coinbase actually was after the close today. No, sorry, I misread that. On the 30th. So yeah, Coinbase, handful of the big tech stocks. Intel is tomorrow. That could be interesting given the recent surge here. But yeah, we got plenty more action on the next earnings reports coming out for sure.
We do. Next week is going to be heavy with all kinds of stuff.
I mean, is earnings the thing right now, or is it really more price extremes? I mean, what is the dominant consideration for this market right now? I mean,
my theory is that since October the 10th, it has been price extreme, and that the market has fundamentally changed in its risk appetite profile. But of course, to your point, we could be one great tech earnings report away from the markets going, the hell with it. Run it up again.
Agreed.
With that, I suppose, overtime is out of time. Don't go anywhere because this conversation continues in mere moments as I try to make sense of this gold move, what it is and what it isn't. And in the meantime, we'll come back to this conversation in 23 hours' time. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan. Mike Butler in Chicago. Thank you, gentlemen. Everybody stay put. We'll be right back. What in the world is going on with gold prices? That's what we're going to attempt to figure out today. Obviously, there's been less of an exciting story to be had with stocks that have oscillated back and forth, though, of course, we'll take a look at that as well. But gold prices have really stood out this week with some tremendous moves. And we're going to try to figure out how, in the absence of a clear lead from economic data or monetary policy or some such thing that all this is going on and what it might mean. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And this is going to be another one of those fun exercises that we've enjoyed since the start of the government shutdown, where we try to divine the macro narrative without the benefit of any economic data or anything immediate from sort of usual channels from where such things tend to be inspired. And instead just go to the price action and try to see what the market is actually saying here. So let's look at that price action. We have here today's performance. I think we can clearly see here it is a soggy day for risk sentiment. S&P off a little bit more than 0.5%. NASDAQ off a little bit more than a full percent. Rates down, so bonds are higher by about 0.3%. Crude oil storming higher, 3.5%. There's a number of things going on here. Gold manages to finish the day with a very tenuous gain. So we were down quite a bit. We then fought our way all the way back to a 0.25% rise. Obviously, put that in the context of yesterday's historic 5% decline. So obviously, what we've managed to do here is effectively stall. The euro basically not going anywhere, neither is the yen, so the dollar is idling today, but Bitcoin is once again doing its risk appetite on steroids thing, and in an environment where stocks are down, it is down more. So that seems to all be right with the world relationships wise. And the rise in crude, an interesting thing. This seems like there was a variety of things that are on the menu here. There was some headlines about maybe India is going to dial back their imports of Russian crude in a bid to mend the relationship with the U.S. It's been a little bit feisty around the buying of Russian crude. Modi and U.S. President Donald Trump have had a little bit of a tense few months of conversation around it, but there were some headlines that maybe we're going to get to the other side of this thing and India is going to dial back, and we're going to, against that backdrop, get a little bit of a rise in price because, of course, Russian crude is sold at a tremendous discount because beggars can't be choosers. And when you're completely buffeted by sanctions, you got to sell to who's going to buy at the price that they'll buy at. So there was that story. There was the little bit that came out around maybe the U.S. is ready to buy a little bit more for the Strategic Petroleum Reserve, the Trump administration refilling that. So that may be added to the demand a little bit. And of course, the little tiny corner of economic data still reporting, the EIA numbers on weekly inventories gave us a decline of almost a million barrels, 0.96 million. So almost a million barrels out of inventory against expectations of a 1.2 million barrel build. So a surprising decline in U.S. oil stocks as in inventories, and the first decline in 4 weeks. So that sort of adding to the overall atmospherics here for crude. Of course, it was also at a critical level as far as positioning goes. Prices sold off back to levels that marked important bottoms in let's call it the first half of April and again at the beginning of May, right around that $56 figure on the WTI contract. And so all kinds of things coming together seemingly here to give us this bounce in crude. It's starting to close in on the 60 level again, which was the bottom of the range that we attempted to break and successfully cleared going into October. That's what got me short, a short that I'm out of as of this morning. And we'll see if that holds. And if we then have a new range to work with, perhaps somewhere between, let's call it 61, 62, and these new bottoms around 56 once again. But the really interesting bit here is perhaps elsewhere. And that, of course, is what this gold sell-off was all about, to begin with what it is and what it isn't. Because really looking at what it isn't seems to tell us not just about gold, but the broader markets too. So, was this some sort of a debasement trade gone into reverse? Obviously, there's been all kinds of chatter about there is this massive rally in gold, and what this is evidence of is the debasement of US dollar-based assets and of fiat-based assets in general, and a desire for gold as an alternative. It's a cute story, really. But unfortunately, for the people that are clinging to it, it doesn't seem to match reality. And the way we know that is we can look at where the bottom was in gold in, let's call it near the middle of August into early August. And we can see here's the gold rally. And here's how both long-term U.S. bonds, in this case, this is the ZB contract, the 30-year note. This is the DX contract, the dollar index future. Through that period, we can see the dollar actually gains, and so do bonds. So if there was a loss of confidence in U.S. dollar-based and generally U.S.-based assets, if this was a sovereign risk, a currency crisis, some sort of a debasement concern, what we would see is a parallel sell-off in the dollar and a parallel sell-off in U.S. treasuries. Because what we would be looking at then is capital fleeing fiat U.S. assets and going to gold. It's just not what's going on. In fact, it's even less so what's going on from this starting point. I just didn't want to cherry pick this for sort of evidence clarity. We wanted to go to the start of the move in gold, not the start of a move in another asset to sort of bias the evidence in favor of this argument. But if we look at right here, this is the Fed on the 17th of September. Since then, the dollar has gone up. And had we started at this inflection point where the dollar's move appeared to turn, we'd be looking at a more sizable advance than just 1%. But nevertheless, very clearly, these are not, first of all, adjacent. Gold is up, even with this latest sell-off, almost 13%, whereas the moves in bonds and the dollar have been much more constrained. Certainly no collapse there. And also, they're not even moving in the wrong direction. They're not even down on net through this move. So even if you wanted to make the argument, well, look, gold is jumpier, dollar and U.S. treasuries are much, much, much more liquid, and so they're not going to have the same kind of volatility. Well, they're not even going in an inverse direction. So it's very difficult to paint this as some sort of a debasement narrative. whether gold, by the way, is going up or down. Is it maybe something having to do with Fed policy? Well, that also seems unlikely. The likelihood of a October cut still approaching 100%, in the high 90s, where it's been for at least a week and almost there going back a month. That's this right here, but at least a week. Same thing for the December meeting, fully baked in and has been for at least a week. So we certainly aren't seeing anything here that would suggest that there is the kind of Fed policy volatility that would give us these kinds of swings, again, up or down. Things have been just generally stayed here. We still, of course, have a disparity into next year, and that's giving us this interesting situation where the markets now have 73 basis points on the menu in cuts for next year, and about another 2 cuts. Obviously, the pricing is imperfect when you get into the dates of these futures contracts, but we can see here where essentially 40 basis points baked in, even at this sort of top-down view for this year. So that explains how we have, once we adjust for the meeting dates, the other 2 meetings, October and December, that we just looked at, approaching 100% likelihood. So that much is clear-cut, and in fact, the outlook for this year has been relatively steady. For next year is where we have volatility, and the markets are much more dovish than the Fed. We can see the Fed is only forecasting 1 rate cut next year. But clearly, the markets have shown no appetite of substance to deal with this disparity, at least for now. It just keeps growing. And we can see that the outlook for this year has been steady through this adjustment. It's the outlook for next year that's on the move. That's how, over the course of this most recent move, from essentially a sort of late September peak in the wake of the Fed's move, that's right here, that's about September the 29th. Since then, over the course of now almost a month, we've become more dovish, and that's been because the 2026 outlook has been that. And that could be supportive for gold gains. But also, this hasn't exactly turned the other way to explain the gold losses. And it's certainly not anything that you might have expected to go down without notice for the dollar, and yet we can see, and we'll come back to this momentarily, but you can just see here immediately, as you've become more dovish, the dollar has nevertheless rallied. So the dollar just plainly does not care that the outlook for the Fed is becoming more dovish for next year. It's interestingly a similar story in stocks, which were rallying with an increasingly dovish perspective for months, going all the way back to where the post-Liberation Day kerfuffle and the correction thereafter petered out mid-May. That's right here. Since then, more dovish policy expectations have meant higher stocks until these most recent peaks in October, where you're getting more dovish on the outlook, but stocks can't do anything with it. So for whatever reason, this disparity continues and has widened, and no market seems to terribly mind this way or that. It certainly doesn't seem to be inspired toward anything. Risk sentiment dynamics appear to be either disconnected or looking at something else or doing something else. And if you were to look at the makeup of them, stocks have stopped rallying. The dollar is rising despite all of this, which seems to all suggest that there is a sort of risk-off flavor to what's going on. Now, If there is, how does that make sense with gold doing what it's doing? Well, it doesn't seem to. Unless you start looking at some of the more granular details. And this is where we start to look at the price action. So this massive decline that we saw this week, the last time we saw something like this was August 7th, 2020, over 5 years ago. That's the last time anything like this one-day sell-off occurred. Now, what's fascinating is that sell-off on the 7th capped a 9-day winning streak, or a 9-week winning streak, excuse me. Here, a winning streak that ran through the week starting August 3rd. Obviously, we can see here the week of August 3rd is where we get the 9th week of gains in this sequence. And then by the end of that week, we get a massive sell-off that caps it. This is the same scenario. We've had exactly 9 weeks of gains here that we have now capped with a move like this. So this was the top in a 9-week advance. This was the top in a 9-week advance. And the last time we had either this kind of sell-off or a 9-week advance was this reference window 5 years back. Now, the last time that this happened, here was the peak. This is that week of August 3rd peak. And we can see until we got to what became a bottom, until this down move, series of lower highs and lower lows, worked its way down, found a bottom, and then started to do something else, we saw a decline of 19.2%. At the prices that were there at the time, that amounted to a decline of $398.23. If we look at what that would look like here, both in terms of dollars and in terms of percentage change. If it was in terms of dollars, then we've run the move. I mean, essentially, this week, the sell-off has given us the $398 sell. But in this environment, prices are obviously much higher than they were 5 years ago. This is a 9% decline, not a 19% decline. If you were to look at this in percentage terms and look at it in terms of magnitude of swing relative to the price as it stands, not in dollar terms, then we're not nearly done yet on this sell-off if we follow these same dynamics. Then we get a 19.2% decline. That ends up being an $840, almost $841 decline, which tellingly takes us right here within striking distance of this range top right around the 3,600 level, give or take. And so it could be that what this is a pullback to retest this before we sort of attempt to figure out what's going on. Now, why is this occurring? Well, if it's not the debasement move, if it's not anything to do with Fed policy, it may very well be the same kind of thematic dynamic that we are seeing here and here, which is to say maybe we've just reached a price extreme. Stocks can't rally on Fed rate cut expectations building, though they had. And so perhaps we're running out of steam on that. Perhaps we've reached a kind of speculative wall. The dollar was selling off on things getting more dovish and can't anymore, and hasn't in fact set a lower low since July. Again, maybe we've reached a speculative wall where everybody that wanted to have this exposure either has it or is already on the way out. And so perhaps what's going on here with gold and these wild swings isn't anything at the macro level at all, and is just a market that hit a record high, not unlike the S&P or the NASDAQ. Dollar didn't hit a record low, but it certainly had a record-setting sell-off in the first 6 months of the year. And maybe these moves are just out of gas, and speculative interest in them has dried up. And so we're turning. And that would perhaps give us more interest in considering this dynamic, if in fact things are just getting started on what is a sort of speculative reset. As far as data is concerned, we got a little bit from the UK. Inflation numbers came in softer than expected overnight. We're going to get Japanese numbers coming in, so they basically bracket our calendar here as we go into U.S. inflation numbers on Friday. Special release even amid the shutdown. We'll talk about that in exhaustive detail on tomorrow's show. You can see here the thing we end up with is UK inflation holding unchanged for a third consecutive month at 3.8%. That's obviously after a spirited rise, and we can see the expectation was actually that we'd go all the way up to 4, and we didn't. So a little bit soggier here, but because the surprise factor was on the downside, the pound weakened a little, but ultimately, since there isn't really a downtick here as much, doesn't seem like we could make a tremendous amount of hay out of it, and so the pound is ultimately a little changed, as is most of the anti-dollar universe. On the earnings front, Tesla came out a little bit better than expected on EPS. That's the last big earnings release for the week. Obviously, there are a gazillion others. The calendar for tomorrow and for Friday is still very thick, but we can just look at the market cap here. Obviously, Netflix was another big one, about $500 billion there. We can see that there's just not this kind of heft in a lot of these other names. Not surprisingly, everything is locked up in the Magnificent Seven, and so the next time we have to care about earnings is probably next week when the next batch of big tech names comes across the wires. Positioning-wise, going into the overnight here, I'm still long the dollar since it seems to have stopped falling even in response to a dovish Fed expectations. I'm a little bit short gold here, looking more so for vol extraction than anything directional, but I'm short a call vertical, and we'll see how that goes. Obviously, I'm biased toward this speculative excess around markets unwinding across assets and gold being a part of that story. And so I'm biased short by selling calls, but because I'm short premium here, it would be just fine if vol just came out of it. Also, since we're looking for that kind of a correction in risk taking, I'm still short some risk on stalwarts, S&P, NASDAQ, Bitcoin, which has been soggier than the stock indexes and is attempting to take out its range bottom, and still long the bonds, which are begrudgingly cruising higher, especially at the long end. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading. And And we are back on what is still a cane founding week for all kinds of assets. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan. Mr. Mike Butler back with us, our returning champion in Chicago. Of course, this is overtime, and we're going to try to make sense of what these markets are doing after hours while keeping an eye out for these Tesla earnings. They should be showing up any moment now, theoretically. Obviously, Netflix didn't do us justice yesterday. The markets didn't like them, but it doesn't seem like today's indigestion in the markets had anything to do with that. Gentlemen, what do you make of this? We kind of gave up momentum today after barnstorming at the start of this week.
Yeah, it was kind of crazy. I mean, we had I was on the show today when we had that flash 30-point sell-off that has since been gobbled up. But we're seeing some resistance here. I thought it was just going to be a rocket ship like up here, but we didn't get that. We're getting another big range today of uncertainty. However, I will say volatility futures did not move at all today. We are still in contango, and that's, I think, even more interesting than this intraday move. Like this move today, I thought would have created more of a flat vol curve and more of a spike in vol futures. You did get a little boost in the VIX itself, but even that got crushed to end the day. So it may have just been an algorithmic digestion of something that was said about two countries working together or not working together, and then maybe it was walked back. I don't know. What do you guys think about it?
I mean,
Dylan,
at this point, I'm going to go back to my sort of default position. Forgive me, which is that all thought is bad thought.
That's fair.
Thought, the enemy of progress.
Well, I don't know about progress, but it's the enemy of profit for sure. So I've been through this more than once, as we all have, and I'm actually very grateful that our celebrity guest host for the day is Mike Butler, who is a strong subscriber to the buying of the dip, as it were. And I would say anytime this thing gets squirrely, obviously a little squirrely today. But again, like I fooled myself with some thinking a few days ago because we had that big sell-off. You can see the chart. All the things. I didn't care about the sell-off. We fought our way back. But then last Thursday, 6 days ago, we found ourselves in another sell-off, which I misinterpreted as a result of my thinking as, oh, this is a negative sign, blah, 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 blah. But actually, it's all an opportunity to buy the dip. I mean, there's nothing more reliable than buying assets when they are on sell-off cycles. So if you have a sell-off cycle today, it has to be an opportunity to acquire assets. It's the only reason, it's the only reliable thing in this entire market is the tendency or the reliability of buying these sell-offs, including the one today.
In fairness, the sell-off today does ultimately find support where previously it had resistance. So that range that got carved out last week as the markets were digesting the holy moly sell-off on October 10th, that carved out a little range. At the start of this week, we stormed through the top of that range, of course, ran directly into the highs and stopped cold right there. Couldn't make it over. And as we pull back today, we pull back to the top of that range, but pointedly, we don't get back into it. We don't break back down. So whatever upside breakout there was on Monday seems to be holding for now. Obviously, Tesla pending. In my mind, when you start to unpick what the markets did last week and this week in the wake of that big sell-off, I don't think we're prepared. I'm certainly not prepared to declare that big sell-off wasn't the mark of a major top. Obviously, that major top was going into a week with lots of earnings. And last week, we tested this theory. Last week, the markets attempted to rally and attempted to rally again and attempted to rally again day after day, and they couldn't stick it. This week, obviously, they started much stronger, ostensibly because we have actual tech earnings with significant market cap this week. We didn't have that last week. We just had the banks. So you go into this week and the markets even out, essentially. They erase the October 10th sell-off. They basically reset. S&P resets, NASDAQ resets. They don't manage to do anything more. And then the day that the earnings actually start, which is yesterday, because Netflix is kind of the first of the two that matter, the two big kind of market cap behemoths this week. Before Netflix, everything stalls. Netflix overnight disappoints. We get a pullback. Now we get Tesla. In my mind, we're still looking to figure out whether October 10th was the real deal. And we don't know.
But don't you think we do know? I mean, we've been at this for a decade.
I don't think we know, because I think there is the obviously correct assumption that we are in the midst of a technological transformation akin to telecoms, akin to railroads, akin to the radio, transformational things. Our friend Andrew Ross Sorkin just published a book called 1929 about what led into that debacle. And he was just talking about it on Bill Maher's show last week and sort of very nicely illustrated. We went into that with this level of exuberance. Only that time it was the radio and RCA. And the RCA was the NVIDIA of that day in terms of market cap, in terms of level of speculative fervor. That doesn't mean that we're going to collapse here. Now, who knows? But it's not like we haven't seen this movie before, and it's not like that collapse canceled radio. It didn't. The collapse of the .com episode didn't cancel the internet. So when we talk about, okay, well, there's a supernova afoot, obviously there is. The question is, at what point do you get the kind of initial washout before the real thing has a longer arc? Where does the kind of hype cycle initially that always accompanies these things in the beginning, where does it hit a wall?
But don't you think that that's like the exception that proves the rule? In other words, that like it's easy to point to the situation that says that this horrible thing is going to happen.
Right.
But 99% of the time, the horrible thing is not what happens. And worrying about the horrible thing that's going to happen is a way to not make money.
I mean, if you're talking about 99% of the time on a given day on the way up in a bubble, the horrible thing isn't what happens, then yes. But if you're talking about 100% of the time, these kinds of things end in a debacle, that's likewise the case. And we can go back to South Sea warrants or railroads or whatever great technological breakthrough you can think of post the Renaissance, which is about as old as we have.
But the fact that you can refer to these situations indicates how exceptional they are. The fact that there's a book that's a bestseller, that's super popular, that everybody's talking about 1929, it's not an indication that that's going to happen. It's an indication that it's so unusual and so extraordinary when it does happen that it's worthy of a book 100 years later.
What it is a distillation, and we've seen similar ones from Dalio, from Howard Marks, from you name it, people who study these things. is that when these types of frothy situations occur around the advent of revolutionary technological change that is transformative for the economy, this happens every time. So the question isn't, is this exceptional? It's not exceptional. It's not exceptional at all. We don't get transformational technological revolution on a regular basis. That's the part that's not exceptional. But every time we get one of them, there's this kind of sequencing to it. And so the question here, in my mind, isn't is it going to happen again? Of course it's going to happen again. The question is obviously from the perspective of timing. And to your point, if you're an investor, then of course this is exceptional in the grand arc of equities generally being biased higher over a period of decades.
But if you're a Tasty Trade customer or a Tasty Live viewer,
yes.
Are you going to spend your life being Mike Butler and buying the dips when they happen because you make money 99% of the time?
Mm-hmm.
Or are you going to spend your life trying to set up for the one time in 100 years that the whole thing falls apart?
I think you set yourself up for both, and the watching of price action becomes a critical exercise in that sense. Because, again, it's not that this happens once in 100 years. It's that this happens every time that there is one of these transformational technological booms. I mean, the last time it happened was 25 years ago. So when you look at this and you say, okay, all the ingredients are there, but the price action doesn't tell me the holy moly is upon us, well, then you do the Mike Butler. But if the price action tells you, hold on a minute, something is different, you back up. And if you're a glutton for punishment like me, then what you do, despite all of your best risk management efforts, is when you see the thing get weak-kneed, take a stab at it, take a little loss, and that's going to be inherent because the bubble is going to be the bubble until it's not the bubble. So there's going to be a lot of this that goes wrong. So as long as you manage the risk and lose a little, the hope is when the inevitable is upon you, you make back multiples of the little losses that you made along the way.
Yeah, I think there's something to be said about both angles, but this is where like the Tasty Live viewer comes into play in the sense of like making more intelligent decisions. Like even if let's say you want to buy the dip all the time, I'm always going to revert back to the vol futures. Like if I see a 60-point sell-off in the market and I see no movement in vol futures and contango in vol futures, I am way more willing to buy the dip in that environment than if I see a Friday movement where you've got a 150-point sell-off paired with a 3% move in the front month future, which put it 2 points ahead of the next one. The second you go into backwardation, all bets are off. And I think that is the most important thing to learn from a vol curve standpoint, because it speaks to both of your points of, I don't want to think, I just want to buy every dip. That applies to me in the contango futures market where we have low volatility. But when we go into backwardation, if you look at the past 10 years of big sell-offs, 20% or 30% of the equity markets, every single one of them had backwardation in the vol futures. So if you just pair that with, if we are in backwardation, I take the foot off the gas. But if we're in contango and I see a sell-off, I'm just going to buy that dip until proven otherwise. But at the same time, you can't go crazy with it because these vol futures will change on a reflection of something that's already happened. So we were in contango on at the beginning of the week where we sold off 200 points. But on Friday, we went into backwardation after a 200-point sell-off. So you have to be mindful of that as well. But I think buying the dips, it still makes sense to do so, especially as those moves grow and grow to the downside. Like the tariff stuff is a great example. At a certain point, and that speaks, I think, to how markets are now versus how they were before. Now you have 10 companies that basically control the market. Before, it was similar, but not as extreme. Like the extreme valuation of these companies that rule the market, at a certain point, when people see and when retail traders and institutional traders see that these companies that are not going anywhere are down 30, 40, 50%, at some point somebody's going to step in, and that creates the reversal. And I don't think we will be, I don't foresee a situation where we have markets that don't have those velocity moves to the upside and downside, even when we have super turbulent times. But even in like the worst case,
my whole concern is that there's 1,000 reasons always for why the market can crash or can decline substantially or whatever it is. But I'm just going to come back, not like a broken record, but that so much of the time it's a situation where that doesn't happen. And so you get yourself into a situation where all the thinking tells you that this is not a good idea, that this is not advisable, that you don't want to do this. But at the same time, 99.9% of the time, the correct decision is not to get lost in that analysis, but rather to take advantage of the fear and the anxiety, and then ultimately buy the assets.
Which is, I think, exactly right. And why you have to look at the price action, to Mike's point, and not just the sort of baseline price action, but the architecture of the price action. What's vol doing? What's price action doing relative to vol? Sort of, where are you? Because you can't, I think, blindly buy the dip in this environment. But also, that's been the thing that's worked, and it will continue to be the thing that works until it doesn't. And there is no telling when that is. Macro, my discipline du jour, is notoriously terrible at timing. And so if you don't anchor yourself in the price action and you just spend all your time thinking about all the bad things, Dylan, to your point, that could happen, you'll miss everything all of the time. You have to let the price action be your lens.
I mean, what price action exactly are you talking about? Because the only price action that I see is every time you get a decline in prices, the beneficial trader is the one who buys the decline.
Take a look at the S&P 500. It hasn't made a new high since October 10th.
And since anytime there's been a pullback, it has ultimately returned to an ascending.
It got rejected from it again today. We're
are you better off to get short the S&P, or are you better off to buy the dip?
I think if you're a trader, then you are much better off short the S&P as a new allocation of capital, because the risk reward is orders of magnitude better. Now again, as a trader, laying out fresh money, not a long position you've been sitting on, not anything where you're fighting other exposure that you might have. If you're looking at this with fresh eyes and you're saying, okay, right here in the S&P, am I closer to a top? Do I have more room to go up or more room to go down? I think very clearly, until you break the October 9th, 10th highs, you have very little room to go up because they're still holding you in. Now, if you break those levels, it's a different story. The whole risk-reward math is reset. But as long as you're sitting under those highs, you're much better off short. That's much better odds. Your risk-reward is many times over better. Because if you're wrong a little. And if you're right, you're very right.
And
I just feel like, listen, go ahead, Mike. Sorry.
by short, you mean like spreads? Like, are you saying like
risk
shorting?
Carefully,
Yeah.
small risk defined verticals that, for example, I'm doing in SPY and the Qs because I don't even want to go to MNQ. Even that's too big because you're fighting a market that's not going that way. So what you're doing is you're taking opportunistic pot shots with the idea that anytime you have no idea when this thing is going to turn, and chances are it'll rally in your face until it doesn't. And so what you're doing is when this thing looks weak kneed and the risk reward looks good, you take a little nibble and you see. And if it goes, it goes. And if it doesn't go, then you lose a little. And you can do that 10, 20 times. But if the turn becomes what it becomes, and as it inevitably does in these scenarios every single time that we have records of anyway, then all those 10, 20 micro losses get absolutely swamped in what is an avalanche of selling. And then you buy that dip.
It all comes back to buying the dip.
But that dip is a 20% dip, not a 2% dip.
Yeah. No, I hear you. But yeah, I think when markets that are at highs, when volatility is low, in hindsight, that was the perfect situation to try and take advantage of something like this that we did not yet know was going to happen. But now we have a little bit more elevated IV, which is going to increase the cost of something like this a little bit more. But yeah, I mean, a 20-point wide diagonal spread where you're reducing the cost basis by 30% on the long option you're buying with the sale of a short option that has half the amount of time is a nice hedge to the downside. Even if you're wrong, you can move this 20-point wide that you paid $8 for. You can move this into a 10-point wide and reduce basis even further. And now if you have bigger long-term upside plays, this doesn't even matter because you've offset it. So
no.
Yeah, I think
that's exactly it. You're opportunistically saying, okay, yeah, vol's a little bit higher, right? There's no free lunch in markets, but you do have a range that extra vol has now carved out for you in the S&P, in the NASDAQ, where you have a near-term bottom where the October 10th thing landed, and you have a top. And so you have risk-reward guardrails where you say, okay, if it goes above this high, I'm wrong. If it goes below this low, it's a bigger sell-off than just another point of consolidation. And so if you're near the top of that range now, you go, okay, yes, I have to pay up a little bit more for vol, but I have very clear risk-reward parameters. So in waiting for this range to set up and in waiting for vol to go up, I've basically spent a little bit of money inherently to have very clearly defined barriers to say, let's take a stab at this thing while the risk reward of 2-to-1 better could be had, and let's see. And if it fails, it fails. And the next time you attempt that isn't when it makes a higher high, it's when it gets cold feet again. And so you try again.
Yeah, I think it's fair.
I just don't see how you can advise. I just don't see how you can advise. I mean, how do I say this? I just do not see how you can advise anything other than buying the dip. Yes, there is a chance at some point that something will happen that is horrifying and a catastrophe of sorts. But at the end of the day, 99 times out of 100, what you're dealing with is an opportunity to buy assets at lower prices in advance of a rally. It's just what it is. I mean,
I think exactly why you have to look at the price action. You can't just be selling into rallies because you think that eventually they're going to fail. That's a recipe for disaster.
What specific price action are you looking for, and what does it communicate?
On October 10th, we set a high with a massive sell-off we have not been able to overcome that high. Every time we attempt to come back from that high since that sell-off, we fail over and over again. So when you fail again at the same high, you go, okay, maybe this really is a top. Let's take a stab and let's see. And if it takes out that high, then it's not the top and you lost a little. But if it is that high and the thing turns into an elevator down, you have made many times over what you're going to lose, which is why you use verticals, risk defined, why you use smaller instruments like the ETFs, in my mind. But why you would also run for the hills were you to break that high.
Yeah, fair points. But yeah, I think, again, it's hard to time when the collapse will happen. But even when it does, and this is why, like, if you're exclusively investing in SPY or the Qs, for example, even when it does, your worst case scenario is 30-40% down in a year. And to Dylan's point, if you can absorb that, you now have a basket of opportunities to do whatever you want to the upside, because
long as you didn't tie up all your capital in holding forever and you were nimble as a trader. Again, if you're an investor, and I do that also, just not with the same brain and with the same strategy, but if you're an investor longer term, then all of these washouts are just reasons for you to keep some powder dry so you can buy more without getting out of your long-term holdings and just accumulate forever, decades on end. But that's not what we're doing here. We're opportunistically trading markets. And in a 45 DTE world, when you've had the kind of run we've had, and when the history of these runs is what it is, they end in tears every single time. You just don't know when. The question is, could it be in the next 45 DTE cycle that it ends in tears? Yes. And you just have to know that and be ready for it. And if the opportunity presents itself to say, well, maybe the market, the price action is tipping its hand that it might be here, take a little nibble. See what happens.
How about Tesla? Down 8.
So interesting reaction here. Shall we go over the results here?
Sure.
So Tesla, third quarter adjusted EPS of $0.50 or 50 cents. That's a miss. Expectation was 54 cents. And the GAAP EPS is 39 cents. That's a miss versus 62 cents expected. Revenue of 28.1 billion. That's a little bit of a beat. 26.4 was expected. Operating income of 1.62, a little bit below expectations of 1.65. Gross margins of 18%, better than 17.2% expected. Free cash flow is the real standout. 3.99, almost 4 billion versus 1.25 expected. So really a huge beat on free cash flow, but soggy on the earnings. Obviously, the real question is what happens here going forward, because that EV credit is expiring, and that's going to change this landscape completely. So the guidance will be really important here.
Yeah, it's well within the expected move. Only down 7 points now, rallying off the lows. But yeah, I feel like we've seen this a few times with Tesla, where we have this implied move that's significantly greater than what we actually get. It is very interesting to see.
Yeah.
But I mean, don't you think, again, that's an opportunity? Tesla, anything is an opportunity to buy Tesla. I mean, there's nothing more significant than what we've been talking about for the last whatever half hour, then it's an opportunity to buy Tesla. I mean, whatever it is, any decline is a decline that is an opportunity. I mean, there's nothing more, there's no better example.
I mean, this is really the key, right? Like when we say every decline is an opportunity, I think we have to qualify the size of the decline, because clearly not every decline is an opportunity. We can see it in the Tesla chart. There are days where you get a sell-off and then the next day you get more sell-off. So if you bought the very first down day, there's plenty of instances here where you've lost money. So in a trading world. So, and in fact, if you look at where Tesla is at the moment, I mean, we can see it, I think, clearly here on the chart that we have up on the screen. Tesla is only back to where it was essentially mid-December of last year. It clearly had a massive sell-off from mid-December all the way through mid-March of this year. If you blindly bought every one of those dips, you'd be down money most of the time. And at this point, if you just held, having bought that first dip near the top, you'd be barely break even now. So obviously, not every dip is a buy. Clearly. The question is, how much of a dip is a buy? Because when we say, oh, we'll buy every dip, buy every 1 day dip, every 1 week dip, every 1 quarter dip, none of that is consistent, especially for Tesla, which is just barely back to square after its early in the year sell-off, in the sort of grand scheme of things. So again, it comes down to price action, in my mind, anyway.
Well, I think it comes down to price action. It comes down to liquidity. It comes down to company size. Like,
yeah,
when we say buy every dip, I'm agreeing with 20%, 30% discounts on Mag 7 stocks or tech stocks that are not going away, or even airlines. Like when we see a sector get bailed out, that's a green light for me if it ever gets back down to those lows. Like it's a scenario where if we are not letting a company fail, I think that's an even better opportunity to invest in a company. But that's, I guess, maybe another discussion. But to Dylan's point, if you are SPY, QQQ only, it makes a lot more sense to buy more dips, because these are not companies that are going to zero. These are charts that, if you look at these charts, even in the worst case scenario, these get gobbled up quickly. Like this is obviously a longer time frame, but this has been insane. We've seen big velocity to the downside and upside. Here's COVID right here, and then we just rocket shipped. But that's again because these companies benefited greatly from everyone being locked inside of their apartments and homes.
Yes.
But yeah, these products, the Qs and SPY, I think I'm more inclined to buy more dips. Companies,
well, of course, they're much more liquid. Their dips are likely to be shallower, almost by definition.
Yeah, totally. Products like Tesla specifically, I want to see a bigger dip. Like I want to see 10%, 20% or more before I'm like, yeah, definitely getting into this. But like Nvidia, I think I'm more inclined to buy more dips on smaller moves, because this is kind of rating the companies that I personally believe are not going anywhere and will continue to go to the upside. But naturally, you have more volatility with Tesla. So higher vol products that give you realized moves, I think it's easier to be more patient because you've seen bigger sell-offs, bigger moves, and bigger opportunities in the past, where Nvidia, I guess you could say the same in this short period of time. But if you think this thing is going to 400 eventually, and that's your thesis, then I think you need to acquire for that idea ultimately in whatever way you want to, whether it's short put spreads, long stock, long call leap options, like, and that's another layer. Like if we see another tariff situation where Nvidia gets cut from 180 down to 90, I'm going out to the 2028 leaps and I'm just going to buy the 200 strike leaps. Like
which is a whole, yeah. I mean, that's a totally, yes.
Yeah.
That's no longer a 45 DTE conversation. It's no longer the kind of opportunistic thing you're talking about. Now you're saying, okay, forget investing into cash equities and big funds over a 20, 30-year time horizon. Forget also the kind of jumpier, more opportunistic month in, month out, month and a half in, month and a half out type of thing that we're talking about here. Let's talk medium term, somewhere in between that. Yeah. I mean, I'm doing this with EWZ, which is one of my big, long equity positions, where you had a big breakout. If you look at a weekly chart, you can really see it. You had a long structural decline. Take a look at a 1 week. Yeah, there we go. So you get a long structural decline, and then you broke that decline. I mean, that to me is okay. So buy a bunch of leaps and wait. And when there's a dip, buy more, because you're not going to figure out what's going on in Brazil to this level of granularity day in, day out. But obviously, something has changed. The big picture is different. Take your shot. Which, I mean, I think I've been holding them now. Let's see. I have been holding these EWZ calls for 170 days, and they don't expire until mid-January, and I'll probably roll them for another year.
Yeah. I like it. There's layers to these things. There's layers.
I mean, it's a different type of an idea.
Speaking of layers, there are gold shavings flying from the rooftops.
I love
Dylan,
it.
I know you were short gold, long dollar. Are you flourishing in this move, or what are you doing here?
I mean, what I'm doing is kicking myself because I really just popped up on being more short gold than I am. Long dollar, fine. But again, if you saw the conversation with Jamal, I was all verbally like, oh, short gold, blah, blah, blah. But I honestly didn't do it beyond the sort of existing sort of Radigan trade, which is marginal, and kicking myself. And so, so I got a big mouth and a small bank account as a result. So good luck to you with that, but at least I have the sort of moral gratification of being right.
There's always that.
That doesn't pay the rent. And so the real question is, what do you do with gold now that it's broken?
So I have a whole spiel on this that I'm going to do on macro money right after this, but I'll give you guys the sneak peek. What this sell-off did in gold was end a 9-week rally. Consecutive 9 weeks of gains. The last time we had a sell-off of this size, over 5% in a day, we also ended a 9-week rally. And in fact, that was the last time we had a 9-week rally. And that was early August 2020. Going into that month, Jackson Hole, where the markets, and this is just context, where the markets thought, the Fed is going to do something on top of open-ended QE and rates to zero because COVID, yada, yada, yada. And then as you started to get into August and into mid-August, and it started to be more apparent that no, the Fed is not going to do more, that they're not going to do negative rates, that they're not going to do yield curve control or some other form of extravagant, unorthodox easing, that gold topped. And so then as now, you had 9 consecutive weeks. Then as now, you get an over 5% daily sell-off to put the top on those 9 weeks. What happened last time, and again, this is a sample space of 1, so this is exactly Dylan, the kind of situation that you were talking about where sometimes, rarely, a thing occurs. So 5 years ago, this thing occurred that was almost identical to this in terms of its setup. And in fact, the last time it